All right. Welcome, everybody, to another Sunday session here. We are blazing our way here through summer. It's hard to believe it's already a month into Q3 and earnings season is upon us. So should see some nice earnings here in the next couple of weeks. I'm looking forward actually to not just the Canadian earnings, but also looking at some of the US shale companies and what sort of production they report, and then also what sort of gas to oil production they report. So certain companies like Pioneer, for example, their oil production is roughly flat, but the gas production has gone up 15% in the last year. So giving you a sign there of further kind of increasing gas oil ratios and further degradation of the acreage, further parent-child well interference, and even possibly getting into that boundary-dominated flow on some of the more fringe wells. So yeah, looking forward to that. And a few things here before we begin today's session. So this is not investment advice. I'm not a registered investment advisor. So please do your own due diligence. This is a very, very volatile sector. And I will actually discuss that today, given that we are talking about some of the junior companies of the past. So not ones that currently exist today. They either got bought out or they got acquired or they merged into something else or they went under, various different things that happen with these companies. So please do your own due diligence. It is very, very important, especially in this sector, and especially if you're going to be foraying into the junior space, especially the junior growth companies, because junior growth companies are unique in that they outspend cash flow. So you could have a junior E&P that is just maintaining X amount of production and they're generating free cash flow. They may be debt-free or paying dividends. That's all fine. It's the growth companies that really require an excessive amount of due diligence because they're outspending cash flow. You have to make sure that the wells are making sense, the geology is making sense, the financing is making sense. They're not overspending on interest and G&A and maybe taking on risks that are too aggressive. Of course, every company wants to grow fast. Every company wants to grow with the help of debt. So those things can be very, very profitable. Those things can take you under in a very, very short period of time, as we'll find out here and discuss as the presentation continues. Also, please check your own risk tolerance. So this sector is not just volatile, but there's certain elements of risk here that exist, which are different than other parts of the industry. So whatever your risk tolerance is, may be also worth discussing with a registered investment advisor or just running your own modeling or any sort of simulations that you are. And also, please check your portfolio construction. So in this sector, especially, the way you construct your portfolio is maybe even more important than the commodity price. So obviously, commodity price dictates everything and how companies will do. However, the way your portfolio is constructed with different segments of it being certain companies or weighted towards gas or oil or towards growth versus companies that are keeping production stable, for sure something to keep in mind. So definitely want to get that out there right at the start. The mailing list is also growing. So if anybody wants the Zoom links on through their email and you want some of the files that are being sent out, please shoot me a DM or an email. I can get you on there. It's really just to get the Zoom session into your calendars. So that's really all it is. Everything else is on the website anyway. So I don't have any other things that I've been sending out right now. The newsletter is going to begin in August. So that's going to cover the activities of White Tundra Petroleum, along with the 5 or 6 E&Ps, private or public, small E&Ps that we have taken bigger stakes in. And then also we'll cover some of the bigger names. So Surge and Tamarack and Obsidian being the 3 right now that are going to be on the list. So it's just going to be information about their well results, about the licenses they're pulling, any land sales, any other information, just to keep people up to speed And yeah, I think that may be sent out on the mailing list. It may just be posted on the website. So we're still kind of thinking about how I want to do that. But I was planning for August 1st, but now I'm planning for around after the first long weekend there in August. So maybe August 8th or 10th, somewhere in there. And it's going to be on a monthly basis. The portfolio also, I mentioned this last week, but the portfolio on the website has been updated. I'm going to update it again here at the end of the month. There has been a new addition, so I'm looking forward to sharing that. But definitely see lots of value out there. I think we are in a very similar price environment as we were in, call it, September to December of 2021, where we saw WTI rising. We saw the big issue ending, where at the time it was Omicron. Right now it is the kind of the oversupply that had kind of got created in March, April. We see those issues, those major issues becoming less and less of factors as time goes on. Whereas at the same time, even though the price is going up of the commodity, the equities may not respond in the same fashion. So certain companies respond very aggressively. Certain companies, they just lag for a variety of reasons. There's not always a reason. Sometimes there is, but the equities lag. And I think, speaking from my own perspective, maybe from some of you listening as well, the vast majority of the biggest gains I made throughout the COVID cycle was between September to 2021 to, let's say, March or May of 2022. So even before we hit the peak, a lot of the options were just rocketing up. Some of these small to mid cap companies were rocketing up, and that's really, as a value investor, the best place to be. So again, not investment advice, but I do see really good opportunities right now with the fact that we've been able to wait and see the OPEC plus cuts hit the market. We've been able to see US shale continue to drop rigs, and yet some of the equities have just not responded. So yeah, either way, long way to say that the portfolio will be updated here by the end of next week or so, and put that on there. The session is also recorded, so it will be on YouTube just like any other sessions by the end of the day. And as well as the Twitter space, obviously, is always recorded. So that will stay on there for the next little bit. And then, yeah, I think that's kind of about it. So a quick reminder, anybody on the Twitter space that would like to join for the Zoom visuals, this is a very visual-based presentation, but also there's a lot of text that I'll be reading out. So I think works for both ways of kind of listening in. But if you do want to join for the visuals, whitetundra.ca, scroll to the bottom under events, and the Zoom link is in there. So we'll get started. Today's session is something a little bit different that I wanted to discuss for a couple of reasons. We've gone through a lot of the junior companies in the current space over the last year and a half, 2 years. I think I've done 5 sessions on the junior company deep dives and really enjoyed those. I think I got really good feedback on those, in the sense that they weren't the most popular sessions from like a view count or any sort of thing, but the response I got from those was a very, very detailed response. So any emails I would get were very long and very in-depth about maybe investors that had invested in those companies in the past, or they had a plethora of questions that they wanted to ask. So I think I really enjoy that more detailed engagement with the audience as well. So I think going on that, there's not that many junior companies left anymore in Canadian oil and gas. So given that, wanted to go back and talk about some of the companies in the past. So when we say the past, I'm talking about 2010 to 2018 or so. We're not going to go previous to that, although we can. The information quality just gets completely degraded, and it's just very difficult to also talk about that because I wasn't in the industry. So for me to go back and talk about a time frame and make insights about them when I really didn't live it is a little bit harder. Maybe at some point we do end up looking at some of the very successful companies in the 2000 to 07 cycle, but that's going to be down the road here. And the second reason I wanted to share today's presentation is because of the similarities. So there is this kind of mentality or maybe false narrative in the Twitter world. Maybe it's in some of us internally that the junior space is dead and everything here is just not worth your risk reward. And the assets that we're talking about, we're just making up stuff that, oh, maybe this could be water flooded, maybe it couldn't, maybe a polymer flood will work, maybe a horizontal will work. But that's not really the case. I think the people who are new to the sector may think of it that way because it's portrayed that way. But in reality, some of these technologies that we're talking about, water flooding and polymer and CO2 flood and horizontal drilling and increasing recovery factors, this is the same thesis that we had since 2013, 2014. It's the exact same thesis. It just didn't get capitalized in Canada the same way it got capitalized in the US. The US also had really produced a lot of oil using vertical wells out of their conventional acreage. So they went and they drilled everything. They CO2 flooded everything. They water flooded everything, at least most of it. Whereas the Canadian acreage, because there's less companies, because it's a little bit more expensive, some of the royalty rates can be a little bit more burdensome, didn't get the same treatment. So many fields were just produced vertically until it was easy, and then they were just left. So the big companies left them, or even the small companies didn't capitalize them in favor of going and drilling new wells because the Canadian conventional space was so hot at the time. And so many discoveries were being made. And then at the same time, in 2010 to 2014, companies went into the Montney or the Duvernay, where you saw this first inventions of hydraulic fracturing and huge production increases that were happening. So the conventional space, the small wells, just kind of withered away and got left. And really the point that I hope to get across in this presentation is it's the same assets, it's the same geology. We have even better technology than we had in 2014 to 2016. We have companies that are in much, much better shape from a balance sheet perspective. And we got much better netbacks on the barrel because the cost of everything is lower. And also, we today are getting a higher price for a Canadian barrel than these companies did in 2010 to 2014. So you look at medium oil in that kind of time period, it was getting maybe $75, $80 Canadian per barrel, even though US WTI was at $95 to $100 a barrel. US, now we see, okay, WCS is trading something like 65-ish Canadian, 63 Canadian, or 63 US, and that translates to 80, 85 Canadian once again. So we're already at that point staring into a bull cycle. So at that point, I think I found fascinating. Couple of points up front is this is going to be part one. So we will cover about 15 companies today. There is a total of roughly 45 that I've identified that I do want to cover over time. However, I'll just be completely honest. I have been learning a lot of things as I made this presentation. So compared to some of the other presentations I've done, where really I'm just sharing things that I've already researched or that I follow anyway, this here was a lot of new information. So really enjoyed learning about the companies, learning about the assets. Some of the information I knew, yes, some of the assets had gone transacted, so I knew about them where they are today. But there were some other cool little, well, not just little, but cool major realizations that were made as I made this presentation. So that being said, and then along with how much time it takes to just go and find historical information that's not easily accessible, I wanted to keep it to 15 companies at a time so that I can do these more regularly than have a huge session with 45 different companies and just throw out too much information out there, given that most people may not be familiar with any of these companies or maybe only one or two of them. So there's that. And then today's presentation is not supposed to be a complete over detailed analysis of the companies. It's meant to just show you the different kinds of companies that existed, how they raised money, what they exited at, what caused their downfall in certain cases, and what resulted in the multi-bagger exit in some cases. So There's going to be a lot of, call it, main level detail. And then, of course, all the files that if one of them really interests you, all you got to do is go to CDAR. CDAR has all the files of the company, every news release, every MD&A, every financial statement. It is a historical record of that company out there. And then I've actually been able to find corporate presentations of most, if not all, of the companies that I'll discuss today from the early 2010s. So if one of them is one that you really want to know about, again, you can shoot me an email and I can send that to you, or you can find it on the web archive, but you might have to go through many different archives to find the one that actually got saved in that. So maybe what I'll do is at the end of this, I'll just send out all the files that I have to the mailing list, and then everybody just has them for whoever is curious in the future. So so with that, we will begin. And I want to start off with a little bit of history. So I talked about how I wanted to share this presentation because there's so much similarity in what we see today versus what we saw in 2010 versus what we saw in 2014 or 2016. So, people ask me, well, given that the prices dropped from 120 to 75, has your thesis changed? And I just about fall off my chair laughing, because the thesis has not changed since 2013/2014. It's been the same thesis. And if we go even further back, the energy scarcity, oil scarcity thesis has existed since maybe 2000. The only things that stopped that were a financial crisis in the biggest economy in the world, and then the invention of shale. And then we saw what happened last year, the actions of it. So it wasn't a structural change in the market. Other than maybe US shale, you can say was a structural change, but it's short cycle and it's high decline. If shale was a low decline phenomena, we would have had a major structural change in the market, leading to oil not being investable for many, many, many years. But given where we are now, I think we are running the exact same thesis as we did. So as we go back into that, here's some of the historical examples that I find interesting. So this article is from 2016, February 28th, 2016. The article reads, "Is Canadian natural resources a safe place to wait for oil to rebound?" So we are here 7.5 years later, and we have the exact same question being asked to us investors, to people who are active on Twitter. So Canadian Natural has sort of always been this bellwether of the industry, especially in the Canadian side. And a lot of investors feel like, okay, that is the place to go to wait for that rebound, but may or may not be true, because when we look at the valuations that companies currently trade at on a relative basis, and then we also look at what happened in 2020. It's not really a fair example to use 2020, but Canadian Natural definitely fell faster and harder than some of their similarly bigger peers in the Canadian space. So fell all the way down to $9, whereas companies like Suncor only fell to the high teens, I believe, and less of a percentage loss. So definitely one to think about when you look at downside protection. It's not just being in the biggest, baddest name out there. There's other factors to keep in mind, which is the current valuation of it versus its peers, and then just historical trading, how it's traded. CNRL, you got to give kudos to them, though they have never cut the dividend. So that does provide this safety net compared to other companies. Another headline here reads, "A recent deal makes Tamarack Energy's undervaluation readily apparent." Sounds like the exact same thing that I hear today and that I'm preaching today. So Tamarack Valley has always been sort of this acquire co in the past. The things that change, that make it different from today versus then is, and we'll talk about this as the presentation continues, but making deals at 5 to 8 times cash flow versus making deals at 3 times cash flow, which is the difference between then and now. And also oil price falling $50 a barrel right away after the deals were made, versus maybe prices rising 20, 30, 40, 50 barrels per barrel in the near future. So that's what makes the two deals different. The overall mantra or MO in the acquire co model hasn't changed. It's the exact same model. It's just buying things cheaper and staring at a bull cycle versus buying things at a $90, $100 pricing environment, which just adds on more downside risk versus buying something in a $60, $65, $70 oil environment where you have relatively higher downside protection. Yeah, for sure. There's a very active individual on Seeking Alpha, Devin Shire, and he used to post a lot of information about junior oil companies, basically one after another, lots of different articles. And it's kind of funny you say that, Al, because I saw your comments on the Seeking Alpha comments. So I think many of us often forget that the people that are investing with us, the people that are on Twitter, the people that are on these Zoom sessions, some of them have the history of many years in this space. So when I go and look at people and I talk to them, and somebody strikes me as an incredibly patient individual in this sector, they usually have the history that they've gone and been investing in the sector for 10, 15, 20 years, because that's really what it takes to understand the fact of how much money you can make in a very short period of time in this sector for doing relatively little things, just letting the company do what they do, which is simple. It's oil and gas. They don't have multiple streams of income. But essentially, there's another article here, a comment that reads, and this is a comment on the Tamarack Energy post here, the headline that I just read out. And the comment just goes, it talks about nobody caring. It talks about this company being thrown out with the other plays that don't have production, and they want to put $1 million into JV and buy up 10% of the company and go on the board. They want to do a debt pay down and do a share repurchase over time, and they want to keep the forward locations in them in the company in the ground until they're drill ready, and or sell the company. So we've always had this sort of view of the oil and gas sector. So when companies make acquisitions, when they go and buy big undeveloped lands and they grow them, we need patience. The oil industry doesn't work on a aggressive, very a fast-paced environment. You need to drill the wells. You need to make adjustments to your drilling and completions methods. You need to get the money back from the wells you're drilling, use that cash flow, and then reallocate it. If you grow way too fast, you're going to create a very high decline rate in the company. You're in this treadmill, possibly even in a conventional company, and you just are susceptible to short-term volatility price movements and taking on way too much debt to grow in that sort of way. So I think we're all very antsy. We want to see more buybacks. We want to see more dividends. Yes, but the company's current balance sheets and the way that they're growing has to also make sense. So if you think you're alone here in this oil sector where the companies are not listening and you feel like the valuations are not correct, this has happened before. It's been going on for many years. It's especially prevalent in companies that make acquisitions that are growth acquisitions. So sounds exactly like what Tamarack has bought over the last couple of years. Both the Charlie Lake and the Clearwater are exactly that. And when you have that sort of acquisition, patience is definitely required. And of course, higher oil price juices up the returns majorly, but patience is required sort of either way. Another article here reads, Iraqi Kurdistan, one of the world's most coveted oil fields. We see headlines out of Iraq saying that they're going to get to 7 million barrels per day, 10 million barrels per day, 13 million barrels per day. This is not new. They've always had the geology to do so. They've always had that oil in the ground. It's just the ongoing civil war, the hesitancy of companies to invest in there, the issues with production continually getting shut down, as it is now for the last couple of months, is what creates these problems. So when we talk about oil and oil supply, we do have easy ways to increase supply in a world with no geopolitical issues, in a world where money is free, in a world where you can go anywhere and do anything. We do have the supply. Even some of the cheap supply is still out there. But the reality is history proves that this oil just doesn't come out of the ground easy. There's a lot of issues with bringing it online and increasing production. So when people just write off like Venezuela, or they just write off certain entities from increasing production, it's not because we're perma bulls or we just think, oh, that thing will never come online. It's because the history proves it, that, okay, if there has been a significant change or catalyst in what you're saying, sure, let's look at it. But if you're just keep on repeating the same headline that Iraq is going to increase production and they're going to jack up the market with more supply, that argument holds no weight if nothing has changed. If you come and tell me, okay, the government is lowering the pay sharing agreements, or XYZ company is going in and investing billions of dollars, which may be happening as we speak, or there has been a huge production increase, or they've invested in produced water disposal capacity. Okay, now let's have a relook at the place that we're in and see if supply can really be added. Until then, it's just a waste of time to go and continually checking for new information where we know over the last 10 to 15 years, there's been relatively very little progress in what they're trying to do. And this one, a headline that is going to maybe not shock too many people, but also is very interesting. August 28, 2013, Athabasca Oil Corp, a big long-term option on innovation and high oil prices. There you go. And when did they finally reap the benefits of this headline? 10 years later. So Athabasca obviously being by far the best performing Canadian oil and gas stock this year, at least the one that is well known and big enough that people can invest in. So here you go. Here's the innovation that has been talked about for 10 years. So they did innovate in the Duvernay and the Montney with Murphy Oil over the last few years, but really the innovation on the oil sands part of their projects. At this time, actually, they didn't even own Leismer, if I'm correct, but it was talking about Hanging Stone and Dover and some other projects. That these are good projects in high oil price with some sort of new innovation. These projects are fantastic, and that's exactly where we sit today. So going back and reading, for those that have a Seeking Alpha subscription, I'm not recommending anything, but if you do have it already, going back and reading some of these articles is really great, because it shows you how long some of these companies have been working on the things they can now implement in a higher oil price environment. So when I'm saying that, when I go and say that this company can go and increase production because they have this asset that is capable of polymer flood or water flood, I'm not just saying that because I woke up one day feeling bullish on a company. It's because the history shows that, the adjacent fields show that, the changes in technology prove it, and we just need higher prices and that innovation in order to execute on that. Here's one. Lightstream Resources CEO John Wright and I are in a similar boat. It says they've been telling that Lightstream is a compelling investment opportunity, and for a long time the stock market has been telling us that we are very wrong. And this is during the bull cycle. So Lightstream Resources was about $35 a share in early 2010. It had fallen all the way down to $5 a share by late 2013. Does it sound like they were in a bull cycle? Not at all. So when we do end up getting to higher valuations, when we do end up getting to higher oil prices, be very, very cognizant of investing in companies that are buying their peers at 8, 10, 15 times cash flow because they don't have the internal assets or the internal reserve lives. This is why I'm very supportive of companies that are making acquisitions at 3 times cash flow at a $70 or $75 WTI, because as the market runs, the companies that didn't make the acquisitions are now stuck and their share price will start falling, which is completely ironic and opposite because they're making acquisitions at prices that are maybe even above what they're trading at. So this company, unfortunately, John Wright ended up putting $5.6 million of his money into this at this point in time. And the company went to zero in 2016. So I think people have been bullish or perma bull on the market for many, many, many years. They got cratered out of the market. Then they sat through a period of 5 or 6 years of just pain and suffering. And we sit here now staring at the cycle and have already made a lot of money from 2020 to 2022. So given that situation, when I get asked, well, how come you're so patient? How come you're not watching the quarterly results? And how come you don't feel like tracking these companies day by day by day? It's because I've been in this for 10 years. There's nothing here that's going to rush me into exiting my position or becoming completely euphoric. I think we all ended up there in 2022, but we are going to see that again. So that part of it doesn't scare me. We've had the exact same thinking for a while, and not just me, but people who are running these companies have had that thinking for a while. So yeah, I guess just goes to show you that a lot of the companies, some of the companies may not make money in a bull cycle, in a cycle where we end up in higher price environment and then stay there for a period of time, multiple years. Be very careful of which companies you're buying, especially ones with poor reserve life indexes, because they are going to be suffering in a very, very competitive market. Few more from the past. So this one is our own Martin Pelletier, who is very active on Twitter. So the question got asked to him was, this is in January of 2010. The question got asked is, with crude oil hovering at $74 to $75 a barrel, which is exactly where we are today, do you think these price levels are sustainable for the next 1 or 2 years? January 2010, about 18 months after we saw the financial crisis. Where are we today? Everybody talking about recession. The world's going to collapse, despite the fact that we already had a recession in 2020. It's this constant narrative and drone. And the reason for that is people are scared. People always are scared. They have very, very near-term bias. They've seen something happen and they think it's going to happen again. Well, the answer to this question that was given is very similar. So he talks about the forward curve for price being very reflecting the fundamentals that were strong. He talks about the fact that capacity utilization in OPEC is going to reach its capacity in the next couple of years, exactly where we are today. He talks about the demand forecast slowly being revised up because the global economic recovery has been strong out of that 2008 recession, exactly where we are today, where it seems like the economy is overcharged despite the increases in interest rates. He talks about the need to get to the demand rationing pricing. What were we discussing all of last year? We need to get to the demand destruction pricing in order to get that supply to come on the market, and in order to kind of that would be the limit where price gets to. And then there is the caveat. So the last few sentences here reads that if global economies falter and equity markets sell off, all boats would sink in falling tides, and that all considered, there's a greater risk to the downside than the upside. So despite every single earlier statement being made that seems to be bullish for oil and gas, the end conclusion being made is a bearish statement because people are scared. They don't want to put themselves out there just after we saw a major recession or a major black swan event. We are in the exact same situation today. The people that are overly anxious and spreading fear and doubt and uncertainty, some of them are not doing so from a place of proper research and analysis. They're doing it because they're scared, they have near-term bias, and they just are putting improper weight on another black swan event happening in the very near term. Could it happen? Sure. I'm not going to be out there saying that everything is rosy in the world and everything is doing good. But just be cognizant that overweight on the negative side of things and trying to downside protect all the time is going to result in poorer gains than having a realistic view of where we are in the world from a fundamental side and from a financial side. It also talks about the price of acquisitions are going to rise if the price of oil or natural gas continues to climb higher. And we saw this happen over time. Here's another example, and I'm going to keep sharing these here with these sessions of companies that did not do well in the bull cycle. Penn West Petroleum went from $24 in late 2011 to $10 a share in mid 2013. Does it sound like bull cycle performance? Not at all. So I think a couple of points here again that I'll make is companies that don't have the assets and keep buying aggressively new assets at very, very high premiums, definitely watch for it. And also, a lot of the money in a bull cycle is made as the cycle ramps up, not when we're already there. Yes, you can make a lot of money from the re-rating of your stocks and really growth in the companies, but a lot of the money is made on the way up as we get to that peak or the sustained peak anyway. So anybody out here saying, well, you're now still going to keep in these oil and gas equities despite the fact that they fell? Well, obviously, because the money is made as we get to that higher pricing environment. Once we're there, yeah, you can make money, but the risk gets a lot higher in terms of the downside risk. The valuations are not as good from a value investing standpoint, and you just have this problem where the company might be running out of acreage. The company might run out of drill locations, and you're susceptible to all these other problems that can pop up. So a point that I really want to get across is if you're going to wait till oil is $100 a barrel or 120, and that gives you confidence to invest in the sector, I hate to be blunt, but you're going to be the same one that's going to be complaining when the price is volatile and certain companies don't do well, that the oil industry is just an industry full of scammers and you can never make money and it's too volatile and blah, blah, blah. I'm sure you've heard people say all of these things because they just didn't have the understanding to get into a sector in its early stage. They got into it once all the risk had been taken out, in a sense, and got caught. And I just want to say once again, everything I'm sharing today is not investment advice. This is my very honest and genuine view of how I see these things, because the people that are complaining about oil and gas stocks are the same ones who buy once the thesis has already been proven out. So why should the market reward you at that point for investing in the sector? Especially when you pick the wrong companies that don't have the asset quality, that don't have the asset base, and are making acquisitions at 6 times cash flow at $100 WTI or 90 WTI. Those are not good management teams that are doing these sorts of things. Of course, hindsight is 2020. We all thought oil was going to stay high for many, many, many years, but you still have to understand what valuation are you buying assets at, and as an investor, what valuation are you buying companies at? And here's an example. So we have 5 companies here, all the way from 145 million to 5.6 billion enterprise value. We have the EBITDA number for 2013, and you can see they're trading between 6 and 10 times enterprise value to EBITDA in 2013. Even if oil price is $100 a barrel at that time, would you invest in that sort of environment? A very subjective question, but I mean, I'll tell you, I did invest in that environment because I started investing in October of 2013. So very early, didn't really run any valuation models. It was more just, hey, I'm doing my petroleum engineering. Let me invest in some of these companies. Very, very basic level research. I was 18 years old. But going back now, looking at this and where the valuations are today, I feel very comfortable investing in the sector, given that sort of difference in valuations that we see. Okay, there's a comment here. April 2015 was the last article published by Devonshire. So yeah, the lower for longer period has absolutely clobbered many, many, many bulls, many people who were very in tune with what was going on in the sector. They followed the companies like the back of their hand. And 1 year of lower pricing just got them out. Now, there could be some other reason as well, but many of these people had a lot of money invested in the sector, in these companies. So that pain, and then the 5 years after that, we sat through all of that, and we sit here today where, again, I keep saying the same word, but I'm very patient here. At this point, now that we have moved our thesis from a short-term thesis to a cyclical investing thesis, it's very easy for me to be patient here and kind of live life and let the companies do what they say they're going to do and let the cycle do what it does. Of course, still got to follow the fundamentals and supply demand and the well results and the assets and the acquisitions. But sitting here worrying about the day-to-day movement is just not a good use of my time anyway. You can still make money trading in and out. And a few headlines from 2014. This is the last slide, I believe, on the history. September 5th, 2014. Is SandRidge Energy really in a position to repurchase shares? Deja vu. September 4th, 2014. Uraners Energy Corp and getting leverage exposure to uranium prices. Deja vu. Every time oil and gas runs and we're in a commodity bull cycle, it seems like the uranium thesis comes out every single time. Alvo Petro. This is a company, I believe, in Kurdistan. 1.2 billion barrels of oil and a fighting chance. We speak the same way today about Gulf Keystone and Shamaran and some of the other Iraqi Kurdistan players. August 2014. An activist investor targets Bellatrix exploration. Are you kidding me? We might be seeing more of this here as we see misratings and companies underperforming their peers. You might see more activism. We already saw it in some of the names, such as Suncor here recently. So the same headlines repeat themselves. Really, though, we are betting on the cycle and we're betting on the companies. So that's essentially 10 years ago, well, 9 years ago, the exact same headlines as we see today. Really, what they got wrong was the cycle and the companies. What we hope to get right today is the cycle and the companies. Oil and gas investing has not changed dramatically over the last 10 years, maybe even longer. Few articles on Lightstream Resources, the company that went under. So October 2014, the article reads, is the 10.7% dividend safe for Lightstream? What are we worried about today? Is the dividend safe for Gear Energy? Is the dividend safe for Cardinal? Is the dividend safe for Peyto? 10, 11, 12%. Just about 6 months later, the article reads, Lightstream appears on track to nearly wipe out its shareholders. Well, balance sheets have changed dramatically since 2015. So we don't really have these risks anymore. Maybe in the very, very highly indebted producer, which there are only 3 or 5 of them left in the entire Canadian oil and gas space, they have this risk. The other ones, they don't go from a 10.7% dividend to wiping out their shareholders in 6 months. That sort of analogy is just not realistic at this point for any of these companies. And then about a year and a half later, Lightstream Resources fails to reach deal with creditors. So think about that. A highly indebted company, when it was first identified as a candidate for bankruptcy, it took 18 months of low oil price after the fact to go under in that environment. When I say that I see very, very little bankruptcy risk in any of these small to mid caps, I mean it, because I have seen companies that were way, way, way more in debt in a much lower oil price environment, and they still survived for a year and a half. Do we see oil prices staying low for a year and a half? Maybe. It's a very subjective question. But if so, you may be reconsidering whether you should be in the sector to begin with. So a couple of other ones here. Another comment by Martin Pelletier talks about what makes a company tick. Well, when we look at a company, we break it to 3 categories, he says: people, assets, and value. He's talking about a technical team that's growing production and has a lot of exploration projects and big upside from waterflood at some properties. They trade at a discount to their peers on a cash flow multiple basis and on a 2P reserve basis. He's, of course, talking about Surge Energy. So not only has some of the thesis on the commodity not changed, some of the thesis on the companies is the exact same. They just never got to run the companies in the way they wanted to by having that technical growth on the new drills and the exploration and the water flooding. They never got to do it because prices were just too low to justify going out and doing these sorts of things. We are now 9 years, 10 years after the fact, with the exact same thesis. And I will make one point. The reason people get a little bit pissed off about acquisitions is because their history with acquisitions is of acquisitions at a higher multiple. So Surge in 2014, they bought Longview at 5 times cash flow in an 80 to 85 to $90 strip. They bought the acquisitions in 2021 at a 2 to 3 times cash flow at a $65 strip. You can see why it's not fair to just go and say, oh, are they going to be the same Surge of the past? Are they going to be the same Crescent Point of the past? You can make these bombastic statements, but they mean nothing because the valuation we bought these assets at is completely different. And acquisitions in the past used to be rewarded. This sort of acquisition sent shares of Longview up 9% and sent shares of Surge up as well. And both companies were paying monthly dividends more than 8% at the time. Really, really good companies. And yeah, okay, so there's a couple of comments here. So it's a less crowded trade today than 6 to 12 months ago. Yeah, for sure. There's definitely less people that are investing in the sector right now. There's less people that are going out and learning about the sector. There's less people coming into these sessions, and really, it really doesn't bother me because I don't do these sessions to go and be some sort of rock star. I do it to share information so that after the fact, when people say, well, how come nobody explained the oil thesis, or how come we didn't know about this? Well, because you didn't pay attention, or you're too lazy to go and look at the right resources. And not just my presentations, but there's a lot of information out there that's being shared. But it's the same with every sector. People come in once a lot of the gain has been made because they don't want the same level of risk. And it's the same in oil, because a lot of the investors here are going to be your bigger funds and banks that are not going to come in until the cycle is well on its way, just to scalp that little gain at the end. And all the power to them. I mean, I invest to make lots of money. I don't invest to go and be in a thesis that's been 99% proven out and then go and scalp pennies on the dollar. And so last slide here on the history part of this. We need an energy scarcity mindset. What drives re-rating in these companies, what drives people coming into these companies is a mindset of scarcity. Here we see scarcity. From 2001 to 2011, Bernstein Research and the Wall Street Journal say the marginal cost of oil production for the 50 largest oil companies went from $25 a barrel to about $90 a barrel. Were they correct in this analysis? For the most part. I think there was a bit of exaggeration being made, given that horizontal drilling was coming up at this time. Not fracking, just horizontal drilling in general was coming up. And this graph also shows you the service cost inflation leading to the marginal cost of production rising. So there is an element of that as well that came up. But you see, they're showing that the marginal cost of production was $90 a barrel in 2011. The price of Brent crude was about $115 a barrel, leaving you that $25 per barrel of netback or juice. So it takes time. It takes time. People don't switch from an energy abundant mindset to an energy scarce mindset in the course of 1 year or 6 months. It's a slow, gradual process, which means that re-rating over time is going to take some time, and it's going to need higher commodity prices and stable commodity prices, as well as the reduction of some of the overlying narratives. So the two narratives being the shale growth and OPEC spare capacity, we'll put those in one basket, and then the renewables are going to take over the world narrative. Those two have to swap completely in order for people to believe that we are in an energy scarce environment. But sometimes all it takes is price. It takes price to drive narrative, and then it takes people wanting to make money to get that ball rolling, and then we're off to the races. So looking forward to that, getting started here very, very shortly, or maybe we're in it as we speak. So, okay, like I said before, we're going to cover 15 companies. Definitely wanted to get some of the history part of it out there. I find it fascinating that we get the same pushback today that we did 10 years ago, and the bull case is pretty much the exact same as it was 10 years ago. Pretty cool to me. And again, just to conclude on my point on all that history is, what did the people get wrong? The cycle and the valuation. What are we hoping to get correct this time around? The cycle and the valuation. So investing at a cheaper, much cheaper valuation into a rising price environment versus investing in a much higher valuation into a stable to falling oil price environment. That's it. That's the only difference between what people failed at and what we are trying to accomplish here over the next few years. So 15 companies we're going to cover today. We're going to start with Arcan Resources, and a company that ended up getting bought out by Aspen Leaf. Aspen Leaf being a ARC Financial backed corporation. So between 2014 and 2016 or so, ARC Financial came in and they backed a lot of companies with fresh equity to go and buy assets on the cheap. So 2014 was the first sign of that collapse. And then 2015, certain companies were in super big trouble. And then certain companies hung on till 2016 because they had bigger asset bases, they had more access to debt, they had more access to debt conversion into equity and whatnot. But some of the smaller companies did go under in early to mid 2014 or 2015, I should say. So Arcan bought out for 11 cents per share in cash, and the consideration offered was 112% premium over the 10-day weighted average trading price. So a couple of points I want to make here. In 2015 and in this cycle, a lot of investors were going into companies that were bankruptcy candidates in order to take the acquisition premium. So a different investment mindset than we have today. Some companies, we can still run that sort of mindset, but it's much rarer compared to what was happening when prices were dropping. The other point I want to make here is these companies have done exceptionally well with the assets they bought. So if there's companies out there today that have low asset quality, that have low asset inventory, they should seriously consider paying a slight premium and buying assets rather than trying to tar kick on every single thing out there, because these assets are going to get more expensive. And also, if you truly want to run a company and you think we're in a bull cycle, there's not that much difference between paying 3 times cash flow and 3.2 times cash flow. Sometimes that's what's required to get that asset and then run it in a bull cycle. So I think many companies are scared right now. They don't want to pay a huge premium because shareholders will not be happy. They will get absolutely shellacked on any sort of social media platform, including Twitter. They don't want to do it. Companies were doing this and they made a lot of money off these assets as long as the valuation made sense. Especially holds true for highly indebted producers, which we unfortunately don't have that many left here for those incredible torque opportunities, but they are still out there. There's about 3 to 5 that are still out there where a big premium acquisition could make sense, and not just make sense, but be very profitable in a higher price environment. And this was the second time that Aspen Leaf tried to take over Arcan. So they had made a bid earlier at about 25 to 27 cents per share. And the biggest debt holder, Stornoway Portfolio Management, voted against it. And in fact, not only did the biggest debt holder vote against it, the convertible debenture voted against it, and the shareholders voted against it. So shareholders were very bullish on the cycle. In 2014, they said, no, we're not going to let this thing get taken over at 25 or 27 cents. The deal got canceled. The shares fell to 22.5 cents, as we see down here. And within 6 to 9 months, the producer got bought out for 11 cents. Who was correct in this situation? Hard to say, but for sure, shareholders were very, very strong in this case. And I think maybe strong in any sort of super cheap hostile acquisitions that start happening here in the next year or 2 years, or that may happen in the next 12 or 24 months. And ARC Financial also took on the Aspen Leaf also took on the $156 million of debt. So running roughly 50% debt to equity at this point in time, 143 million of equity, 156 of debt. So not too bad, still good. And in August 2014, Aspen Leaf walked away. The deal was rejected. Aspen Leaf walked away. Oil prices fell another 50% since that time, and they were able to buy the asset for 50% lower, maybe 60% lower than what they initially had bid. And one cool thing about the Canadian oil patch in the past is a lot of companies own shares in other companies. So in Arcan, the largest shareholders was Crescent Point with 19% ownership, and Lightstream Resources with 17%. So companies wanted exposure to explorcos and new fields being developed. So what they did is, instead of putting their own money there, which they were putting their own money in other plays, they would go and buy 10, 15, 20% of these junior explorcos, so that if they did discover something, well, now these big producers, because they're on the board, they have first information as to what's happening. They can go and acquire acreage around it. They can go and maybe do a hostile bid and even take over the entire company. And they already own a big portion of shares to vote with that. So something that has been lacking so far. There hasn't been that many junior companies come up anyway. But as the cycle continues and you see some exploration start, I would not be surprised to see these cash-rich companies go and take bigger stakes and actually fund these small explorcos, especially given the multilateral play and some of the horizontal development that could occur. And Arcan was in a really good situation because their debentures did not mature till 2016 or 2018. And also they were convertible debentures. So they could be converted to equity and avoid that bankruptcy at that point in time. So the convertible debenture instrument is a very, very powerful tool that can help you in a bull cycle. It can also help you in a sudden collapse in oil prices. And Crescent Point bought some of these shares at more than $5 a share. So they paid more than $5 per share, and they ended up getting bought out for 11 cents per share. Part of the reason that they ended up here is Crescent Point itself went too crazy and bought too many things in 2014 or 2015. So they didn't really have that backing to go and buy Arcan, or they didn't want to buy Arcan. At the time, these assets were in Deer Mountain, Swan Hills, and Hamburg, most of the Northwest Alberta, northwest of Edmonton, and producing about 2,200 barrels per day in 2010 and growing production to about 4,000 barrels per day in 2011. And then the company continued growing as it went on. A couple of things on the assets. So you can see here that they did sell some assets. So they tried to sell 81 sections of land in Swan Hills. Actually, what is this? This is an acquire. They acquired 81 sections of land in Swan Hills for $53 million in cash, 500 BOEs per day. So they paid over $100,000 a flowing barrel on these. This was the going price for some of these transactions that you could grow into in this very, very competitive landscape. So when you look at some fields like the Clearwater today, we look at some fields like the Charlie Lake, we look at some fields like the Sparky, Manville waterfloods. These assets were transacting at over $100,000 a flowing barrel at the time. Not these specific assets, but growth assets with inventory depth were selling for these sorts of metrics because of the competitiveness. And certain companies just run out of acreage. This may seem very bizarre to people, but certain companies you will find in the next 12 to 24 months will just run out of conventional acreage. Companies like Gear Energy, for example, is one that is definitely at risk here of being in that sort of situation. So they then have to go and acquire at these huge premiums. In conjunction with this, Arcan raised $30 to $50 million. It was later upsized to $65 million at $2.50 per share. This is 2010. So investors put in money in 2010 at $2.50 per share. The company grew production throughout the cycle from 2010 to 2014. They were able to acquire these lands. They were able to get 85, 90, $100+ US oil pricing. And in 2015, they sold at 4% of what they initially put in, 11 cents from a $2.50 per share offering. So what is the lesson here is don't hold on too long. That really is a lesson. The lesson is not sell on the first sign of increase in prices or production growth. It is don't hold on too long. When that company starts expanding and they've got to their peak production or they're close to the peak production of that asset, now what do they want to do? They want to acquire more. They want to grow bigger. That means they got to go and do more acquisitions. They got to spend more money. They got to raise more money. These are initial signs that, okay, it may be time to exit these companies at this point in time. Just my opinion. By no means is this investment advice, but I get asked a lot, what is your exit strategy on these companies? Well, certain things to watch for. Companies that were exceptionally successful at raising money, growing production, buying assets for cheap, the only mistake they made was not selling early on enough in that cycle. So definitely keep that in mind. So there's a comment here that I'll get to just after I finish the slide. So here you can look at some of the financial metrics that the company did. So production was growing at about a 50 to 60% rate every single year. We see the impact of this financing increase the number of share count pretty significantly. But also look at this. The natural gas revenues. Let's not even talk about netback. The revenues that the company made in 2010 was $56 million. Their capital expenditures was $148 million. They outspent their revenue to almost 3x on the CapEx. And what did they get for it? Their production went from 2,200 BOEs per day to about 4,000 BOEs per day in 2011. But you can see how the growth rates were just unsustainable. You really bring yourself very susceptible to pricing collapses. What happened? The cycle didn't collapse. The cycle did really well. And these companies made a lot of money. But then they got this in their head that, oh, now we're doing really well. So let's just keep outspending cash flow and keep growing. And that's what led to their downfall. Eventually, I once again will make this point because I find it to be the key point of this slide is when companies have certain assets and they've put production to the max of what that asset can produce. So let's say it's a water flood, let's say it's a Montney play, whatever it is, it's gotten to peak or close to peak of the sustainable production range. Be very careful of what that company does at that point. Do they overcapitalize that asset? Do they just stay and become a dividend payer? Or do they go and acquire companies at very, very high premiums? Or do they go and do organic exploration opportunities? Each one of those is going to pay out differently depending on the success rate and depending on where commodity prices go. If you go and buy assets and you keep buying at 5, 6, 7 times cash flow at 90 WTI, and then WTI goes to 150, great, now you look like a genius. But that's unfortunately not what happened in this case. So as valuations rise, as prices rise of the commodity, the downside risk gets a lot higher. And the management execution risk, the operational risk gets a lot higher. Therefore, you want to be in companies that are not super aggressive all the time and empire building on every single thing. Once we get there, while we're here, maybe a different kind of investment mandate applies. Once we get to higher valuations and higher pricing, perhaps a different investment strategy should be considered. And I just want to say this because this presentation is going to be very opinionated. None of what I say today is investment advice. It's my own opinion. It's how I am thinking about this cycle. It's how I plan to allocate money through the cycle. It's how I plan to exit the cycle. It's some of the flags that I'm looking for as the cycle continues. Okay, so after that big growth in 2011, the Arcan kept production at roughly 35 to 4,000 BOEs per day. 2013, 2014, it's a light sweet, about a 40 API crude oil. Very nice. Up to 40% recoveries using waterflood. Sounds very similar to the company that owns these assets today. Large original oil in place. I have been preaching this for many, many months now. Companies with large original oil in place with low recovery factors that can be improved are going to be the ones that benefit in a higher commodity price environment. This slide is from 2013. The exact same mandate applied back then, because why would it change? When something works in a commodity space, it just works. There's no reason to go and play games with other sorts of different strategies. You can play shale, you can play gas, you can go in other areas, but you have to realize what you're doing. What investment strategy are you running and why? What's the excess risk and what's the excess reward? And it may make sense for sure. But in terms of my perspective on this, large original oil in place, low recovery factors, we're going to increase the recovery factors. Simple. And the reserve life index on these pool at the time, 9 years PDP, 19 years proved, which is 1P. Sounds very similar to what these assets are at today. So I once again will say, when you look at reserves, the reserves that the company tells you or that the reserve auditor tells you is almost always going to be undercounted in a water flooding pool or in a large original oil in place pool, because the auditor never wants to give you credit for your next 25 years of production. They will give you 10. Once you produce a year, they will give you another year. And that cycle continues such that you always maintain 10 years of PDP reserve. We see the same today with companies that own similar assets. And in fact, with the companies that own this exact asset, it's the exact same thing. So I will repeat, when you look at reserves, don't just go off what the company is telling you, and don't just go off what the reserve auditor is telling you. If you want to take a big stake in a company, do the work, put in the work, look at their assets, look at the geology, the original oil in place, find adjacent pools and what recovery factors they got to, and then you can make a good conclusion as to how much oil can actually be recovered out of these pools in that case. And one kind of way to think about this is, if you have reserves for 25 years and you put a 10% discount rate on it, every reserve that's past 10 or 12 years is not really that important in terms of a dollar figure in net present value. Fair enough. If you don't want to run a lower discount rate to account for the fact that we're going into this cycle, fine. That's totally fine. Think about it this way. What if the company doubles production on their water flood and then brings that year 10 to 20 year of reserve into year 1 to 10? What value does it now add to the corporation on something that shows up as pretty much zero value at current point in time? This is the exact same question that any shareholder of Meg Energy or Obsidian or Tamarack or Surge, these sorts of names should be asking themselves, is how much excess value is sitting there and showing absolutely zero value. But if the company chose to, they could increase production out of these water floods. They could drill more wells out of these water floods, or even on their conventional acreages. So reserves is not something that you can just take from the corporate presentation and run with it. It's one of the things where many, many hours of work have to go into it, looking at the geology and the current status of the field versus how much oil is in place. Here's a little map. So we see the main Swan Hills Reef, the main Swan Hills buildup. So the coral reefs here, we're talking about the South Swan Hills unit, the Swan Hills unit, all the lands in that area. And then you have the side play. So on the side of these reefs, you have the reef platform play, which is what Arcan had, which is what Aspen Leaf is running right now, which is what Saturn Oil bought off of Ridgeback recently. it's the platform of the reef. And here's a really good map that shows you what exactly they're doing. So this is lower porosity rock, lower permeability rock, but it goes really well with horizontal fracks, pretty deep, maybe more than 3 kilometers deep. So you have to be understanding of the cost it takes to drill these wells. But at the same time, there's a significant amount of oil in place here. And there's also these patch reefs in the middle that are high permeability zones, which if you hit that, you get a huge slug of oil out of those until they die down. And then you're back into your kind of unconventional production out of these. And you can see how there's a stacked pay here as well. So you have the sands on top, then you have the lower, whatever the lower platform is, and then you have the upper platform as well. So these stacked pays have even more original oil in place than a singular zone that's being targeted. So what happened? What were the mistakes here? Well, over-aggressive growth. That's it. The G&A cost of this company was $7 to $8 a barrel. That's the G&A that these high growth companies used to run. Absolutely insane. The interest cost on this company per year or per barrel was somewhere between $9 and $13 a barrel in just interest cost. So what ended up happening? $87 of revenue per barrel only resulted in $29 of corporate netback. There's companies today at $70 oil that are making more than $29 corporate netback on their barrels because they have much lower G&A. They have almost zero interest. The other cost is pretty much zero. Their royalties are decent and their operating costs are lower. The companies that we have the opportunity to invest in today are a completely different universe than the way these junior growth companies used to run their balance sheets and their operations and their G&A in 2010 to 2014. So I get a lot of concern and a lot of comments on these junior growth companies that, oh, their G&A looks like it's slipping, their operating costs looks like it's slipping. There may be some small operational issues, and I get it. I totally get it. We should be on these companies to be running really, really good operations such that we know what's going on. But we have to appreciate the change that's happened since 2010 to 2014. Not every company ran this sort of G&A and interest, but there was companies like this that were heavily invested in by retail, that were heavily being bought by Crescent Point and Lightstream, bigger producers, and they didn't really seem to have a good handle on things, but that's just the way these companies were. So appreciate the companies we have today. We have really the creme de la creme of the companies that are out there today. And when I was hearing last year that companies were going to go under, they had bankruptcy problems, possibly, I just couldn't even take people seriously anymore because they're not aware of how much things have changed and why the bankruptcy risk on these companies is leaps and bounds lower than the companies we used to invest in just 10 years ago. In addition to that, the economics on the wells have changed. So the wells used to cost $4.5 million for a 1 mile lateral. As we see here in this map from Arcan Resource, all these laterals are 1 mile or even sub 1 mile laterals. And it used to cost $4.5 million. Today, on the same asset, you can see here 6808 W5, we have 6808 W5, the exact same asset. The wells are costing $3.6 million. So a lot cheaper. On top of that, there are 2 mile laterals. So instead of making a IP30 of 150 BOE per day, we're making IP30s of 295 BOEs per day. Much better economics. What does that mean? So 10 years ago, at a $90 flat oil price, $90 US WTI flat oil price, the internal rates of return was 41%. On May 2nd, 2022, at about a $90, $95 strip, which is where we were, the internal rates of return are 155%. The payout is 0.8 years instead of something like 1.7 or 1.8 years. What's changed? Nothing. Nothing has changed except better technology. The asset sat there, uncapitalized, underdeveloped, and technology got better. Horizontal fracking got better. Horizontal drilling got better. We now know that we need to run X amount of spacing on the frac and this much proppant intensity. And now certain companies are sitting on these assets that were found in 2010 to 2014. They were developed in 2010 to 2014, very slightly. And then as the full development plan came into play, prices crashed. Now that same asset sits there, ready to be drilled at much better economics in a much better oil price environment. I keep preaching this. Certain people believe me, certain people don't believe me. And they come up with all sorts of financial metrics that why what I'm saying is incorrect. And they talk about me being an uber bull on the geology side of things. Well, here's the prime example. It's the same asset. This is the asset today. Do you see how many wells are drilled on it? You can see how many more wells remain to be drilled on this asset. The evidence is right in front of your eyes. The people that are talking trash are people that are not putting in the work. They just want to go there and make a scene, create a scene, and unnecessarily talk. Keep on talking because the evidence shows you the assets exist. Multiple of these assets exist today. Water floods. So Arcan had this in their corporate presentation talking about water floods. What makes a water flood good? Reservoir continuity, reservoir characteristics are favorable, contiguous land, large volumes of oil in place, your water source, your infrastructure. Companies that are out there today with some of these assets already have all of this in place. What is the last thing you need? Patience. There's that buzzword I've been using all presentation in the corporate presentation of Arcan 10 years ago. Water floods and these sorts of enhanced oil recovery projects take time. Just because you injected water today doesn't mean your water flood is active. It can take 6 to 12 months for that water to make its way and push the oil in the right direction into your producer. It all takes time. And it depends as an investor, do you have time or do you not have time? That's going to determine what sort of investments make sense for you in a bull cycle. And I'll leave this for the rest of the people to read on the YouTube, but it talks about what you get when you have a successful water flood. And then some of the risks of Arcan. Extremely leveraged balance sheet, a drop in oil price, reliant on one play, and water flooding is new and could disappoint over time. Well, many of those risks have now been mitigated. We don't have extremely leveraged balance sheets. The drop in oil prices is beyond us now, is behind us now. Completely reliant on one play. Well, that's fine as long as the play has enough of a runway to grow. And water flooding is fairly new and could disappoint over time. What has water flooding done? It's been nothing but success over time. So, okay. One last slide on this, the Swan Hills analogous unit performance. So I've talked about this. When you look at reserves, look at the analogous units, look at the adjacent pools. Well, in the past, companies used to do this for you. Now we have to do this for ourselves. Here is the adjacent pools OOIP recovery, AKA recovery factor. You see how there's 6 pools here that are showing recovery factor all the way to 35%. You can see where they are here on the map. So 1, 2, 3, 4, 5, 6, the 6 different pools. You can see the PDP that's been given for these assets. So when you have 5 or 6 contiguous pools that have produced 35% recovery factors, you're only going to be given a 21% PDP recovery factor. Here is the graph of the pool that Arcan was on, this red line. Seems to be the exact same line. Seems we are on our path to 35 to 40% recovery factors. But we are only going to be given credit for 21%. As we keep producing, we keep going up, and the analogous pools are right next to you with the same geology, with very similar characteristics. And that, in essence, is why I love water flooded assets with high original oil in place in low recovery factors. The analogous pools show you exactly what that pool is going to do, barring any sort of major geologic or reservoir failures, which, okay, we can't just use that as our base case every single time. So here's the example in graph form, what I've been talking about for the last few months. And companies also had a lot of tax pools because they outspent their capital in order to grow. They ended up generating a lot of internal tax pool, even in a bull market. So this could be something that companies do here over time, especially the small ones. If they're generating a lot of cash flow, they may not have access to buy tax pools. So what they'll say is, okay, we'll just keep spending more money on capital so that we don't have to pay it to the tax man. Well, which companies can do that? The ones with the assets to grow production. And there's only a few of them. And investors in those sorts of assets should understand that those companies may, in a higher price environment, start growing production, because it makes more sense to do that than to just pay corporate tax year after year after year and just give it to the tax man. Pros and cons to investing in these sorts of assets. Right now, shareholders will never let companies grow production at 40% a year. It just is not going to happen. But as the cycle continues, watch for signs of changes in a company's DNA, which may make you change your investment strategy in that company. Okay, so that's Arcan Resources. Now we got Rock Energy. A quick reminder, anybody on the Twitter space that would like to join for the Zoom visuals, we are at whitetundra.ca. If you scroll to the bottom under events, the Zoom link will be in there and you can join us. If not, the Twitter space will continue as in its audio only format. Here as we go on. So Rock Energy, a very interesting producer. So here is a comment that was made about Rock Energy. One name that's done very well for us is Rock Energy. It is a conventional producer of heavy oil in the Lloydminster area. It's trading at about 4 times cash flow on existing production. And at the same time, they're testing a natural gas play in the Elmworth area of Alberta. It's surrounded by the likes of Encana. So Elmworth being in the Montney play, Rock Energy trading at 4 times cash flow. And the initials of the individual that made this comment, EN, Eric Nuttall. So he used to be very interested in the junior names at the time, having run a smaller portfolio at the time, allowing him to participate in some of these smaller names, let's say. And big fan of conventional heavy oil. Where has he ended up now? In companies like Tamarack and Surge that have conventional medium to heavy oil. Pretty cool to see this statement for sure. And Rock Energy has shallow, low decline, low cost wells, 750 to 800,000 per well, with an average I period of 60 barrels per day. Doesn't sound that great, but it's low decline. So it comes on at 60, it stays at 60 or 50 or 45, and just continues on for many, many years. And what ended up happening was, again, too much debt. So $58 million of debt on this company in 2016. And they ended up getting bought out by Raging River Exploration, a Neil Rosell company, for that amount. And the total acquisition price was about $109 million. The shares were bought out at roughly 80 cents per Rock Energy share. And most of the acquisition was with shares. So yes, Raging River took on the debt, but they also paid for everything with shares. There's no cash being given out. And think about that, 2,500 BOE per day, 95% oil, got bought out for only $109 million. So companies that over indebted themselves in 2016, unfortunately got bought out for very, very low prices. And there's about 25 net sections of land that came with it. I should say it was very low prices compared to the preceding multiple But even in 2016, these oil-weighted companies were getting bought out for $40,000 to $45,000 a flowing barrel. So in 2016, with prices being so low and companies at the mercy of the bankers, they were still getting these sorts of valuations. And in addition to the Viking asset, Raging River got the polymer flood in Ontario. So polymer flood is not a new technology. It's been going on. And some of these polymer floods were initiated in 2014, and they showed results in 2015, 2016. And then the companies went under or they got bought out. So couldn't take advantage of the EOR that they themselves had put in place at the time. And in just 2014, Rock Energy spent $65 million of capital on the Ontario Laporte pool. They got bought out for $109 million. So companies did not mind paying higher flowing per barrel because a lot of money was spent on infrastructure and drilling and delineation already in just the last couple of years before 2016 happened. And you can see here, if they hadn't spent that 65 million, maybe they only spent 30 million or 20 million, sure, production would be a lot lower, but the company would be in much less debt at the time. So over aggressive development, once you're 2, 3, 4 years into a bull cycle, you have to understand the cycle and where it's going. Can't just be spending money without understanding it. Many of us thought that oil price was still going to stay high despite the Permian, despite the Bakken, despite horizontal fracturing. It didn't end up that way. We can't blame anybody, but in most cases, we're seeing that it's high debt that caused the problem in these situations, which is why companies now are so gun shy on debt, even though debt is a very, very important tool for a company to drive valuation on the equity portion of the corporation. So about 80 cents per share is what this got bought out at. And we can look back here. What did Rock Energy raise money at? $5 a share. And who was in this? Well, we have Cormark Securities, Wellington Capital Markets, First Energy Capital, Mackey Research, Alta Corp, Dundee Securities, National Bank, and Scotia Capital. A lot of support for this company at $5 a share and even at $6 a share on a flow-through basis. So all these investors got slammed. And this is why when we say, okay, well, what's the catalyst for these companies to come back into investing in this sector or in the junior companies? It's going to take some time. There's a lot of pain here. There's a lot of loss. A lot of people got fired over these things. It's going to take a little bit of time to bring them back. But again, we keep coming back to cyclical investing and patience. And they're saying their balance sheet is intact, which means debt to cash flow of 1.8 times. So when I see debt to cash flow today of 0.6, 0.7, even 1, and investors are hammering them to go and repay debt, you can repay debt, but is it the best use of that dollar at that point in time? Is it really? Definitely keep that in mind when you're looking at what are we as investors telling companies to do. Implementing the EOR project at Ontario also reduced the royalty rate of Rock from 25% to 1%. So they saved $10 a barrel in operating and royalty cost from this change. So companies did do a lot of cool things in 2014-15 as they were running out of tax pools, as the royalty rate started rising. They started implementing more projects to save money. You'll see this happen again in this cycle. As companies run out of tax pools, as they get higher and higher royalties being placed on them, they will sometimes grow production because it's just so much more efficient than paying dividends or buying back shares, especially valuations re-rate to a higher multiple. And this is the Rock Energy estimate. They created this enhanced oil recovery polymer flood. It came on at about 3,500 barrels per day in early 2015. The production went down to about 2,500 barrels per day by late 2015. And then they have 3 scenarios. They said if they don't do anything, they just keep producing primary with current producers, production would decline all the way to about 500 barrels per day by mid-2018. So in 3 years, it would decline 80% from 2,500 barrels per day to 500 barrels per day. Okay. The current wells, once they put the Palmer flood on it, would go to about 15 to 1,700 barrels per day by mid-2018. So decline about 40% from 2,500 barrels per day to 1,500 barrels per day. Okay. If they did the Palmer flood and they did infill drilling, the production could be held flat at 2,500 barrels per day till mid-2018. So 0% decline rate. Okay, fair enough. What ended up happening? The Palmer flood got shut off. When prices went down, when Raging River bought this out, they just shut the Palmer flood down. Okay, well, in that scenario, we should have been at 500 barrels per day by mid-2018. Here is a graph from PetroNinja of the production of this pool. Mid-2018, we're at 500 barrels per day. That it happened exactly as they said. They predicted 3 years into the future what the production profile was going to be, and that's exactly what happened. And who ended up buying this? Baytex. Baytex got this from Raging River in late 2018. They started increasing production in mid-2019 from about 400 barrels per day. They got to 600 barrels per day, and then COVID hit. COVID hit, production went back down to about 350 to 400 barrels per day. Today, it produces about 650 to 700 barrels per day, and Baytex is working on a plan to continue to increase production here. How much production is left? Well, the way we can calculate production on a time versus production graph is the area under the curve. So you take a graph that's production versus time, and you take the area under the curve is the number of barrels that essentially can be produced from this pool over X amount of years. Look at the area under the curve on the Palmer flood with infills graph, a line, versus the area under the curve on the primary production with no Palmer flood line. They've only really produced about 25% of the oil that should have been produced by now. 75% of it still stays under the ground for increased production. Can they get back up to 2,500 barrels per day? Maybe not. Can they keep it at 2,000 barrels per day for 3, 4, 5 years from the current 700? Yes. Because the oil is still there. The oil still stays under the ground. The Palmer flood equipment is still there. And all they have to do is just restart the Palmer injection and produce the oil. And these are the fields that people are telling me that, oh, you're just making up stuff about these fields. Like any company that's in their right mind would maximize NPV by going and producing every barrel they can today. Welcome to the real world. We don't operate on NPVs. We operate on making the most money in the cycle that is to come, as opposed to just trying to maximize every dollar today and create an unsustainable growth profile on the company. The difference between somebody who is really worked in the sector, and I'm not just talking about me, but looking at people who have the engineering background and the experience in the sector, listening to people who are looking at these things from a financial only standpoint. You're welcome to listen to whoever you want. The reality is companies sit there today with these pools just waiting for higher prices. That's all they're waiting for, higher pricing. Once they get there, the infrastructure is there, the oil in the ground's there, the asset is there, and we actually now have better technology on drilling and geosteering, leading to even better efficiencies, and the oil is still there. This is a Canada unique phenomena. The US has some of these pools, but a lot of them have already been produced to their max economic recovery capacity. Canada still has a few of these, and we have more exploration potential still on these Mannville pools as well. So pretty cool little project here. If I was a producer in the Mannville today, if I was a producer in the southern Saskatchewan area, and if I can pluck this pool out of Baytex, I would pay 40, 50,000 a barrel right now flowing for this pool. I just don't have $35 million sitting in my bank. So can't do so. But this is a very, very tidy pool. Baytex, Laporte, Palmer Flood. Here we can see the map of it. So Montario and Laporte on the left side, mostly being hit with only vertical wells so far. The infill drills are, I believe, the purple ones, future drills. And then they also had an onward Viking pool. You can see relatively undrilled, but also drilling half-mile laterals in the Viking. We are now moving to 1.5-mile laterals in the Viking. So technology has evolved leaps and bounds since these companies went under in 2015 and 16, especially horizontal drilling and fracturing, and especially geosteering in medium to heavy oil thin zones. Those two technologies have come incredibly far in the last 6 to 8 years. So you can choose to believe it, or you can choose to ignore it and treat it like mumbo jumbo. I don't have the map here, unfortunately, but the Montario Laporte pool is unique in that it's the only one in the area thus far to have had Palmer flooding. The overall Montario Laporte complex consists of 6 pools. So there's 4 pools on top. 3, I believe, are CNRL. 1 is Enhanced Energy, a CO2 flood company. And then you have Montario Laporte as the 5th pool. Some of the northern pools have recovery factors in the 15 to 20% range and have never done polymer flood. What does it tell you about the potential of those pools? And one comment, other comment I will make is just 6 to 10 miles to the west, in pretty much the same formation, sits Prospera's Cuthbert pool, where they will be doing a polymer flood trial here in the next couple of months. So Rock Energy also had a newsletter that they would send out, and it reads, in a letter Rock Energy sent to shareholders this month, pointed out that the US rig count has dropped from 1,600 to less than 600 in 12 months. US production has dropped 600,000 barrels per day. Despite the fact that the world still consumes 95 million barrels per day and demand is growing at 1 to 1.5 million barrels per day. Looking ahead to 2016, prices are not likely to improve until inventories have been consumed. Once inventories begin to decline and prices begin to respond, we can consider a more robust capital spending plan. It feels like we figured out time travel. It's the exact same fundamental thesis. It's the exact same inventory destocking thesis. And it's the exact same capital spending thesis, that once prices respond, we will go and develop our assets. Until then, we're just going to produce what we have right now. The exact same language even is being used here. So trust me when I say there's been a lot of pain and suffering in the oil and gas patch. They really believe these things because it is the thesis. They really believed it. They invested in it. But the fact of it is the Permian just became this prolific, absolutely prolific reservoir. And people have suffered through those years. We now sit at the inflection point, or have just passed the inflection point of this same thesis actually coming to fruition over the next couple of years. So that's Rock Energy. A pretty interesting case study, I find, Rock Energy, because they had the heavy oil asset, medium to heavy oil asset, and then they had the Viking high decline, lighter oil asset, a model that many companies are even choosing to go with today. So Obsidian, Tamarack, Surge, Baytex to some extent, Crescent Point to some extent, just instead of the Viking being the cash flow generating growth asset, it's now the Montney or the Duvernay or the Eagle Ford or some other shaly version of the Viking. West Fire Energy. So this is one that I actually held once it became long run. So West Fire and Guide Exploration merged in 2012, I believe, and they merged at some differing common share agreement. and they merged into long run exploration. And this long run exploration was at about somewhere between $4.50 to $6 a share, all the way from 2012 till mid 2014. Okay, great. So didn't really do much. They just stayed where they were, despite being a pretty good company with decent assets, a lot of scattered acreage, but really good undeveloped acreage. Did quite well. And then the bottom fell out. So summer of 2014, prices went down. Long run shares went down 85 to 90% in 6 months. And eventually, in the Christmas of 2015, they were bought out by a Chinese company for $770 million, of which very little of it was shares. So shares were bought out at 52 cents. So a 90% loss for companies, for investors that hung on from the Westfire Energy and Guide Exploration amalgamation, and not a really good end for it. But look at how it was treated. Christmas miracle, it says, as Chinese investors buy long run. So this thing was headed for bankruptcy. 100 million of equity, 680 million of debt. That is a highly leveraged balance sheet. The companies today with 800 million of equity and 250 of debt, and people are referring to them as highly indebted producers. No, that's barely any debt to begin with. I would say they are under leveraged in this oil and gas sector. And long run also bought Crocata. Crocata being the earlier entity of Luke Crota. So Crocata was bought out by long run, and Montney Play, 357 million was put into that. Westfire was also a very aggressive acquirer. They bought 10 deals in 2 years in 2011, 2009 and 2010. They did 10 deals in 2 years. And with those 10 deals, they only got to 2,100 barrels per day. So they ran a roll-up strategy. They had lots of oil in place. They had huge inventory and drilling locations in the Viking, mostly stuff that was vertical wellbores. So it was conducive to horizontal drilling. And after that, Westfire and Orion merged, which valued it at 675 million. And then Orion and Westfire merged with the earlier mentioned Guide Exploration. Then Guide Exploration became Long Run, and the entire entity was bought out for only $770 million. So lots of money lost on the equity side of the portion. The debt portion was relatively okay. Money was raised at $3.50 and $4.25 per share in 2009. So in 6 years, from 2009 till 2015, investors sat through this company buying and buying and buying, getting bigger and bigger, buying good assets, lots of land, acquiring lots of new undeveloped acreage, and then essentially becoming this big entity that then lost them 80% of their investment, 80 to 85 to 90% of their investment. You can see why investors are not really wanting to come back into this sector, and why getting into these companies, once prices have already risen into junior growth companies, has traditionally so far not looked to be like a very profitable endeavor. Of course, when these companies started much smaller, the initial raises would have made money, but the subsequent raises on these companies rarely make money, and why I've never participated in any major private placement for a bigger producer. It's just not, in my opinion, a good investment strategy historically. And Guide Exploration also had raised money in the past. They raised money at $3 a share. And when Guide merged with Westfire, the deal valued the shares at $1.94. So even before oil prices went down, in 2012, the Guide Exploration investors had already lost 35% of their investment. It's very important to be mindful of what you're buying. Very, very important in the Canadian oil and gas private equity space. Even in a bull market, people have found ways to lose money. So definitely one to keep in mind. Okay, Twin Butte Energy. So a very well-known name in the sector because it had gotten to a big enough size that it was relevant, and then everything came crashing down. Once again, 2014, 2015, the mistake that was made, keeping the company too long. In many of these cases, that's strictly the mistake that's been made. I see people here requesting to speak on the Twitter space. I don't take any questions from Twitter. Unfortunately, it screws up the audio recording on the Zoom session. So if you do want to ask something, please join the Zoom and you can put it in the chat and we can talk about it from there. So Twin Butte actually went under. So it didn't get acquired. It was taken into bankruptcy and receivership in October 2016. The production by then had fallen to about 13,000 BOEs per day, all the way down from 17,000 BOEs per day. And actually production had fallen to 11,000 BOEs per day just because wells were not being repaired. You produce something, prices are too low, wells go down, leave them down. No development drilling being done. 88% liquid, so pretty nice production here. A little comment on derivatives hedging. The company made $25 million on hedging in 2015. In the 3 months ended June 30, so Q2 2015, they made $25 million, $16 a BOE. But they also lost $23 million in the previous year, Q2. So $12 a BOE they lost. Hedging traditionally has been a complete mess for Canadian oil and gas, small to mid caps, or even juniors. When they protect themselves, they can't protect themselves with enough such that it saves them over a long enough period of time. And in the meantime, they keep losing money in the bull portion of it because they keep hedging. So this is why I'm extremely against hedging strategies in the oil and gas industry. And also, this is why companies wanted to get rid of the banks, because the banks were forcing a lot of these hedges on them. So now that companies are running low bank debt and more of a term debt, it allows them the flexibility to not hedge anymore moving forward. The company also, at the time, had a market cap of 100 million and an enterprise value of 400 million. So 3 times debt to equity that they were running. They were still paying a dividend, 3.4% dividend, still lots of daily volume. And that's essentially what took them under, is nobody believed the cycle had turned into the downside and how long it was going to stay there. And they also were in the Lloydminster Provost heavy oil belt, cheap wells to drill, quick spud to on-stream times, multi-zone, repeatable prospects, very shallow. And they talked about the horizontal. So moving from verticals to horizontals, 50% lower operating cost, less water production, less sand production, more concentrated development, and a reduction in propane cost because you're running less wells to access the same amount of reservoir. I've spoken about certain companies that exist today in fields that have only been targeted with vertical wells and are now switching to horizontal wells. This is not new technology. This is technology that was created, that was planned, that was developed was allowed to be developed in a very less manner. And those assets are still there. They still only have vertical development on them. And horizontal technology has gotten better in the meantime. I keep repeating the same thing because part of the reason for doing this seminar is not just to talk about junior companies of the past. It's to show you why those same assets sit here today and have not been developed in companies that are investable today. So not just a seminar for curiosity's sake, but hopefully for understanding of current investment and how that goes on. Twin Butte raised money in 2013 at $1.95 per subscription receipt. They also bought Buffalo Resources at a deemed price of $1.97 per share. This was 2013. When they bought Emerge, it was $1.95. When they bought Buffalo, it was actually $2.14 per share that they ended up keeping. and it all went under. In 2016, everything got zeroed out. So again, the mistake that was made was just keeping the company for too long. They did really good. They had really good assets, didn't sell in time, and the company ended up going under. Okay, so there's a message here. What are your top 1 or 2 recommendations? So I don't recommend anything. I'm not an investment advisor. Please discuss this with your registered investment advisor. But I will say my YouTube videos are all public. They're all free. You can listen to all of them and get my opinions on a lot of different companies, along with the fact that my portfolios are all public on the website as well. Yes, yeah. So Twin Butte, Long Run, and Lightstream were paying super high monthly dividends, 8, 10, 12% dividends, sometimes even higher. And that's what got retail into the game. That's what got retail to be bag holding in the game. I've made this point before. Be careful buying oil and gas companies as a dividend payers. They can pay dividends. Yes, they have the capacity. They can increase dividends. They have the capacity. There's risk involved. When you have dividends being paid at a lower price, at a lower valuation, sure. When you have dividends of that manner being paid at a higher valuation in a much higher commodity price, be understanding of the commodity risk you're taking on and the geology risk you're taking on in exchange for maybe marginal gains over a different asset class. I have never personally understood the interest into buying oil and gas companies for the dividends. Unless the dividends are in the 12, 14% range, maybe they make sense at a lower valuation. Today, it makes sense. In a $90, $100 oil environment, to be buying companies just for dividends, there is risk involved. I'm not gonna go in and sugarcoat this. And hindsight is always 20/20, but there is risk involved on your equity portion getting disintegrated. Twin Butte was bought by the Chinese, renamed to Westlake. Yeah. So a lot of these companies, they have the same assets out there. They just keep getting recycled, but really a lot of them have not been developed over those years because the price was not conducive to those assets being developed in an aggressive manner or even in a general growth manner. So there's a question here. Any talks or thoughts on the future of Westcan? Silence for a long time now. I have not bought shares. I have not sold shares. I'm still following the company to the extent that I can. We are waiting to see what happens with their year-end results. So the end of July, I believe, is a deadline. And gonna kind of see what happens with that. I'm still a big fan of the geology, still a big fan of the asset. I hold all my shares as is. And there's really nothing to report at this time. The company is just stuck at this point. They have the asset, but they're stuck because the new well didn't produce to the level that was anticipated. It didn't produce to the level that the geology called for. So at this point, we are just waiting to see what happens. I'm in no rush with any of these companies to do anything at this point in time. But given the other companies that we're in, it's taking less of my time at this point. I still love the geology of that asset. Okay, so I'll address this question as well. So I noticed you sold out entirely of MEG, which is your top holding. Yes, so MEG was sold entirely to fund the Prairie Provident equity financing. It went dollar for dollar into the Prairie Provident equity financing. I held MEG at a 50% margin, which is why the percentage that Prairie Provident shows up in the portfolio now is not the same percentage that MEG was, because I only got half the proceeds in cash. The other half was essentially a reduction in margin. The reason it was sold, relative valuation. That's it. As I see this cycle turning, I want to be in more higher torque names with more financial leverage and more growth potential moving forward. MEG was a play that was exceptionally safe and has 60-year reserves. It is a gem of a play. But I think my initial purchases were in the $13, $14 range. so was able to exit with a significant gain on that, just on a relative valuation basis. I'm not saying it's a company that I should be selling, but given that I have a very aggressive mandate within the White Tundra portfolio, and I am a fan of companies that hold a lot of debt, that's essentially the transition that was made into that. And I think one of the things to look at would be Meg Energy. I'm looking at Meg Energy options going forward, just given that their buyback could really accelerate in a very, very strong fashion at higher prices, especially if the WCS differential stays relatively low. So definitely looking at the longer term way to still have exposure to the company. At this point, I don't have any exposure to the name. Here is a little bit of a timeline as to how the Mannville zone develops. So here is your map. So you have the Viking overlaying the Jolifu Shale, which is your barrier. Below that is your conventional zones, Waseca, Sparky, GP, General Petroleum, Rex, Lloydminster, Cummings, and Dyna. You can see why the Mannville is so attractive to smaller companies. They can drill multiple wells in multiple zones. Some of these zones are less than 2 meters thick. Some are as much as 1 meter thick. The aforementioned geosteering technology has played a major role in producing more oil out of the Mannville stack. The multilateral technology has played a major role in producing more out of the Mannville stack. So 1980s, you had the CHOPS technology, cold, heavy oil with produced sand, CHOPS, and good wells, high operating cost, limited inventory. The results were unknown. If you had a lot of sand getting produced, the well could get collapsed and you would never be able to get ahead of the sand. There is literally millions and billions of tons of sand in the ground. You will never be able to pull it all out if it's just too unconsolidated in that particular well. Lined heavy horizontals in the 2000s, very expensive, and they created negative impacts on the reservoir. Meaning, if you had an underlying water aquifer, the water aquifer would channel into the horizontal and therefore kill your well because the oil was so heavy that the water would just selectively flow every single time. And then you had some perforated horizontals. So a little bit of a perf on it in the 2010s. And you were able to get medium gravity oil out on top of the water pools. Heavy oil, still very difficult to get out with the perfs. Then 2014, keep in mind this timeline. Late 2014, we moved to short multi-frac horizontals and then long multi-frac horizontals. Okay, increase the inventory. You could produce the thinner zones. You could do more reservoir exposure, less surface impact. Great. In 2014, they started running with unlined heavy horizontals. So open hole kind of technology, and it decreased the costs, better economics. You increase the recovery. Why? Because you don't have that casing that's blocking your near wellbore permeability. In 2015, we had unlined heavy multilateral horizontals. Sound familiar? I think not many people knew about multilaterals before Baytex started talking about the P-Vine and the Clearwater. Multilaterals have been around for many, many years. They just never got to be developed. I will keep making this point for the multiple years here, or for the time that I keep doing these presentations and the time that I'm in the sector on Twitter. These technologies existed back then. They were never capitalized and developed until recently. So this is not new technology. You need the technology, you need the asset with the oil in the ground, you merge them together, you add the stimulant of higher commodity price, you make lots of money. Okay, and then we went from the unlined heavy multilateral horizontals in 2015 to the multilateral lithic channels. So more of the, I believe that's talking about the Sparky and then the Lloydminster channel as well, increased recovery factors. And then in 2016, heavy horizontal water floods came on the scene. increased recovery factor, added low-cost reserves. After 2016, nothing happened. Price was too low at that point. And all this technology over the last 2 years that was in its very, very early stage of being exploited and developed never got to be used. So if this technology was around in 2010, it would have been used in the higher price environment from 2010 to 2014. But a lot of it didn't come on the scene till 2012, 2013, late 2014, and then water floods. Even as the cycle had dropped off, it was in 2015, 2016 that the heavy oil water flood in a horizontal manner came on the scene. I don't want to keep saying the same thing, but the learning from all these companies is pretty much the exact same. It's just different assets that have high oil in place that never got to be developed. And at the time, this company was at about 25 to 27 cents per share. And look at the price targets. Every single one is above that $25 to $27 per share. They all have hold or buy ratings. There is not a single on here sell. Some of them are actually sector performs or outperform ratings. It took about 1.5 to 2 years for people to really believe that, okay, we are in a lower for longer price environment. The same works on the way up. It takes about 1.5 to 2 years of sustained higher pricing and no supply on the scene for them to believe in a higher for longer energy scarcity environment. You cannot rush this unless there's some sort of field in the world that just dies, like one of the Saudi Arabian giant fields, or Russian production does actually fall by 3 to 5 million barrels per day. It'll take longer for the world to believe in the energy scarcity environment, about 18 to 24 months. The one asterisk on this, the Permian. If the Permian starts to show significant degradation and production loss in the next 6, 12, 18 months, that realization of the energy scarcity environment might take 6 months less than that 18 to 24 months. Also why the shale thesis changing is so critical to our equities re-rating and the commodity price going up to what it should be at in this sort of fundamental background. Okay. Arsenal Energy. So Arsenal Energy has combined with Lone Pine in 2016 to form Prairie Provident Resources. So 77% was issued to Lone Pine stakeholders, 23% was issued to Arsenal Energy shareholders, and Arsenal had about 1,600 BOEs per day, mostly medium oil and NGLs, but mostly medium oil. And you can see the heavy oil realizations are much lower than the medium oil. So there was a big gap, not just WCS, but heavy oil in general. We can see the fact that the G&A was about $7 a BOE. Once again, a recipe for disaster, and why today's $1 or $1.50 or even $3 G&A is actually relatively quite good for a junior company of this size. The share trading range when it got bought out was about $1.30 to $1.60. So that was where they ended up amalgamating. That was the value of the company at that time. Remember, this was 2016. So the shares had fallen a lot already from the peak of 2013, 2014. Who made money? So when Arsenal Capital first got started, they raised money at 20 cents per share. Excellent. So Arsenal Capital, I believe, was in 2002 or 2003, if I'm not mistaken. So in 13 years, they ended up about 6 to 7xing their shares. Nice, very, very nice return on that. There was a private placement done in 2004 that was at 70 cents per share. Those investors ended up in about 12 years making 150% on their shares if they held all the way to the amalgamation with Prairie Provident. Great. In 2011, Wellington West, PI Financial, Canaccord, Casimir, and Emerging Equities Inc. raised money at 95 cents a share. So the investors from 2004 didn't get that much benefit till 2011. They sat through the pricing increase, but then also 08, 09, 2010, the recovery, and into 2011. They didn't make that much money. So again, in these sorts of transactions, junior growth companies, it is important to get in early, not 2, 3, 4 years into the cycle and 2, 3, 4 years into the development of the assets. Within the first 2 or 3 years of the company being formed and buying their assets and developing them. That's when these private placements end up making some of the highest returns. However, in 2014, money was raised at $9.35 a share. So if you invested in February of 2011, you made a 10x on your money in just 3 years because this was a junior growth company. It was not a company that already had assets coming into 2010. They bought some assets, they grew them, and they essentially 10x'd them in 3 years in a cycle that barely changed. From 2011 to 2014, oil price didn't go up. It was at $95 to $100 a barrel, somewhere in that range. And they made 10x. Why? Because they had good assets. They had good assets that they could grow. And they didn't go out and just keep acquiring and keep buying and keep buying. They grew organically and they drilled some really good wells. If you were an initial investor in this company in 2003, you made almost 50x in 10 years. So there you go. Some people, I'm sure, exited at various points along the growth of this company and made 50x on this transaction. And what was I going to say? What ended up happening after the fact is that the company combined with Prairie Provident at a range of roughly $1.30 to $1.50 a share. So the people who participated in the July 2014 financing, they lost about 80% of their money in 2.5 years. The same company, the same assets, the same commodity cycle. What changed? The valuation at which the investors entered. That's it. That's really the only change here between these 4 different financings. One investor got in right at the start. One investor got in slightly after that, but at a much higher price. One investor got in when the commodity cycle of 2011 to 2014 was just beginning, made 10x. One investor got in very late in the cycle once the companies had already developed their properties and grown production. So the big point or the takeaway here is if you're just waiting for the oil price to turn and you're taking shots at people who are investing in the cycle and saying, oh, look at this, like oil price is 74 now, ha, ha, ha. That's where the money's made. You make money when you buy these things cheap and at good valuation and at the low of the commodity price environment cycle. So perhaps instead of going out and taking shots and laughing at people, time would be better off spent doing research so you can make money on the cycle rather than missing out on the cycle. Not investment advice. This is me sharing the way that I view these oil and gas cycles and why I'm willing to take on and slap on extra risk in quotation marks on my portfolio at today's pricing environment. And in June of 2016, just before this transaction happened, the amalgamation happened, Arsenal actually was debt-free. They had no bank borrowings. So they sold 2 Canadian properties and they sold all their US properties for $54 million, paid off all their bank borrowings, and then they were left with 1,250 BOEs per day. Evie, Provost, and Princess, 3 of the major assets that still remain within the Prairie Provident entity. Here are some of the properties that they had earlier. Then they sold the US property in North Dakota. They sold the property up, a couple of their Canadian properties, and they were left with Evie, Provost, and Princess. One interesting thing you may notice here is every corporation, it seems like, had either a Viking play or a Bakken play because they provided low risk cash flow. Even though it was high decline, the wells were cookie cutter, you were able to produce cash flow and keep production relatively flat at a lower peak and produce lots of cash flow out of these wells that paid back very, very fast. Viking, Bakken, nowadays it's the Cardium, the Shaunavon, these sorts of properties. You'll notice companies even today run the exact same model. They seem to like the heavy oil companies, medium oil companies like having a cash flow generating entity that's higher decline. That same model has stuck with either the Viking or the Frobishers or the Cardium, some of the shale plays, Montney, Duvernay, etc. Look at what Athabasca has. They got heavy oil, but then mixed with the Montney, Duvernay cash flow generation of that asset. So there is this mentality to have both exposure for good or bad. I have no real insight into that. It's just the way the companies historically have done things and kept it on. Also, some transactions here that happened in the Viking, over $100,000 a flowing barrel for most of them. Over $20 per BOE of proved reserves for most of them. We're talking about high decline cash flow generating assets are trading at these sorts of valuations. Valuations will increase in a commodity price environment that dictates it, and in a world that's short on exploration and development prospects, prices will get back here. So transactions today, if my company makes a transaction at 40,000 a flowing barrel and it has water flooding upside or drilling upside, do them all day long, because we've seen what happens when prices turn. Here's some of the unbooked Bakken that they had in the past that they sold, the US play that I was talking about. You can see how relatively undrilled it was at the time. Now the Bakken is super drilled. So things have gotten more developed in the Bakken versus some of the Canadian portion of it. And then here is EV, the EV pool that Arsenal had. So Prairie Provident has gone in and acquired some more land here. They've also grown the production. They've put it under water flood. And this is my favorite statement of this slide. There's 2,500 barrels per day of spare capacity. The current battery's throughput is only 23%. There's also future water flood expansion and chemical EOR potential. We come back to the same point. Properties with huge oil in place, with the infrastructure in place, not going to be developed until higher oil pricing, sitting in a company today. So Lone Pine and Arsenal merged, Prairie Provident then bought Marquis, and that essentially is what Prairie Provident consists of today. Okay, so Marquis Energy, next. So Prairie Provident bought Marquis in 2018, late 2018. They paid with shares, so created 38 million shares of PPR. Some very, very strong shareholders here. So both Marquis and Arsenal and Lone Pine had very, very strong, large shareholders that still remain shareholders of Prairie Provident today. The only reason I know that is because they've reached out to me and said, hey, we came in with the Marquis transaction or the Arsenal transaction. Basically, bought assets in Michichi, and then Princess and Evie also got amalgamated. So there's a certain synergy once you make one transaction to go and expand your asset base in those transactions, in those same core operating areas. And pro forma, Prairie Provident bought about 2,000 BOE was what Marquis was at the time. A lot of oil-weighted opportunities, and again, water flooding upside. 2018 was a great time to acquire some of these properties because the oil and gas cycle was turning by late 2018 before we had the little taper tantrum in the US and the heavy oil diff blew out. because of some of the increased production that came on the market with higher prices. And what do we have here? So Marquis also bought the assets of Sonde Resources, and this essentially made up most of Marquis' production at the time of sale. They bought this for about $34.5 million total consideration and 1,700 BOEs per day. So that same asset essentially got transferred when this deal happened. And Marquis raised $8.2 million when the deal happened at 95 cents per share. And at the end of it all, they got bought out at roughly, let me see if I have the metrics here. I didn't put the sale metrics in here, but I'm going to say that 0.8, so 10 cents per share. So I'm thinking the transaction happened at roughly somewhere between a $20 and $40 million share price equivalent price. So essentially the same assets were just transferred one-to-one, but in a lower oil price environment. And again, investors here got screwed in the flow-through share proceeds, didn't do well. The Marquis Energy assets we can see here, they're talking about oil-weighted growth, the light oil water flood in Michichi Banff, and then many drilling locations. These are the assets that are going to transact. Even in the future, these are the assets that are going to transact. If you have a pool that's declining production, you don't have any growth there, you don't have any inventory left, there are companies like this out there today. Those assets are going to have a very difficult time transacting even in a bull market. It's not going to get the value that it really deserves, or that maybe investors are looking for. Whereas assets with water flooding upside and lots of runway on the drilling location side of things, that's what companies want in a bull cycle. So Marquis was a little bit more gas weighted, so 47% liquids. A lot focused on Michichi. They had 2,000 barrels per day pipeline battery there. They built a gas processing capacity much bigger than what the company was at the time. Lots of tax pools and the market cap to debt. So running relatively low debt for a company at the time. And we see some of the changes that have been done recently. So Marquis was drilling into the middle Banff and the upper Banff, whereas Prairie Provident came in and they started drilling in the lower Banff porosity. So this on the right side shows you what Prairie Provident is doing, fracs in the lower Banff. Marquis was trying to meet both zones. So between the detrital and the middle Banff, drilling on this zone so they could frac into both reservoirs. And ended up getting still pretty good well results, but this is just more of a focused drilling into the lower Banff with pretty high porosity there. The economics on these wells. So these companies, the economics on them changed dramatically from $50 oil to $70 oil, and from $70 oil to $90, $100 oil. One of the reasons why it's so important to remember, oil prices averaged $50 a barrel for 6 years. From 2015 to 2020, they averaged $50 a barrel, at which point the rates of return are 60, 65%. Not that great. At $70 oil, the rates of return go to 150%. That's the incredible sensitivity on these drilling locations and why nobody wanted to go and use them up in a low price environment. Now run the same at $90, $100 oil, you can see why having a huge stack of drilling locations is to your benefit. And then water flooding upside. Prairie Provident has now proved that water flooding works in Michichi. I believe Pine Cliff is also running a water flood in this area. And in a doubling of reserves from 6% recovery factor to 12% recovery factor. When you have lots of oil in place on a new undeveloped field, that's great. Okay, A reminder to anybody on the Twitter space, if you do want to join for the Zoom visuals, whitetundra.ca, scroll to the bottom under events, and the Zoom link is on there, and you can join us if you wish on the Zoom side of things. Blackbird Energy, so the predecessor to Pipestone Energy. Blackbird merged with Pipestone Oil in early 2019. They closed equity financings of $111 million, and also about $200 million of debt got created at the time. And the Blackbird shares were valued at 24 cents per share at the time. And they got 0.1 of each Pipestone Energy share. So 24 cents per share. There was then a 10-to-1 consolidation. So the Blackbird shares, basically, they got $2.40 per share that they had. The price of Pipestone today, roughly $2.40. So from 2019, the company has really increased production. They've delineated their land. They have gone through 2022 and paid off a lot of the debt. But yet the Blackbird holders made literally no money from then till today. And we have our friend here, Joseph Schachter, talking about this. The price of Blackbird fell from about 40 cents per share in all throughout 2018 to then falling to 15 to 18 cents per share in late 2014, and then resulting in the transaction in early 2019 at a price of 24 cents per share equivalent. And just before that, in October 2018, Blackbird actually ended up raising money at 37 cents per share. So they did a really good job of raising money just before the price went down, 37 cents per share. Those investors are still underwater today. And here is your price of the combined entity today. Pipestone essentially did a reverse takeover. So it's the same entity's share price that continued on. And what did Blackbird do? They assembled 78 sections for $6.9 million, $88,000 per section in the Montney, 900 drilling locations. And then the Montney lands in that area were transacting at about $2 to $3 million each. So the price really went up of that, and basically a land play. Blackbird did have a few wells, but for the most part, they didn't really have money to go and develop the property. They were just looking to be bought out in a sense. Could they have gone and developed it at higher prices? Sure, but the prices never came, and I don't think they were able to raise money to drill Montney wells either. So that's a private placement of 2018. They also had a private placement in 2011. So in 2011, they raised money at 20 cents per unit on the flow-through unit, and then 20 cents on the regular unit. And that consisted of one share and one warrant at 35 cents that they could use till 2013. So this graph you're seeing is after the 10-to-1 consolidation. So adjust the $2 to, or 20 cents to $2, adjust the 35 cents to $3.50. These private placement participants made about 50%, 50 to 70% on their shares in about a 2-year period. You can see here by 2013, the share price had gone to $3 plus. Where are we here? $3 plus in about the $3.50 range. So the 20-cent share became about a 30 to 35 cent share in 2 years. Great. The warrant most likely expired worthless. It was only till July 2013, and it was at $3.50 per share post-consolidation. The shares only got to about $3.50 a share. Okay. There was another financing in November of 2013. This financing was at 10 cents per flow-through share and 9 cents per regular unit. So essentially 90 cents now and $1 on the flow-through unit. And that would have been done right here at this point in time. Yeah, 2013 should be somewhere over here. Yeah. So these shareholders made a lot of money. So they also came with a warrant that was a 5-year warrant with a 15-cent exercise price. so $1.50 on this graph here. So they made on their 10-cent initial placement, the shares went all the way to $5.50 by late 2014, early 2015. So they made about 400% on their unit. And then the warrant also, where are we here? Yeah, so the warrant also itself made about another $3 per warrant. So they put 90 cents in, they got $5 out for the share, and they got $3 of value on the warrant. So very, very nice return, a 750% return in year and a half, less than a year and a half. Really, really great return. And what did they do right? They invested as the markets were running. They invested as the Montney became very wanted, and they invested at a very, very good valuation. The price had fallen from $3 to $1 when they went and did this financing. I'm a big fan of 5-year warrants. I'm also a big fan of 2-year warrants being given out on private placements, as long as I am investing in that, not in companies that I'm already invested in. No, companies that I can get a chance to participate in them. Big fan of these warrants, because you get the initial unit, allows the company to grow. You can make money on the shares, and then the warrant gives you long duration upside. As many people would have likely noticed, I'm talking about the 3 financings that White Tundra has done in the last 6 months. All have a 2 to 5 year warrant and invested at really good valuations. At least that's the way that I look at it, obviously, and I'm biased. But these sorts of units on a company that's looking for capital and has the assets, you can get multi-hundreds of % of return in very, very short periods of time. And you can see the share price of Blackbird was about $4 a share all the way till the end of 2016. So the price of oil falling didn't really make a huge difference to their valuation, because they were mostly a land play, and they knew they had assets that companies would want kind of no matter what. It's only when the lower for longer cycle came in and they started drilling their lands and spending a lot of money that the share price started going down, because the cash flow did not justify them developing the acreage. And I think that's all I have on Blackbird. I did have a map, but I don't think I put it in. It's essentially the Pipestone Energy acreage, along with what Pipestone Oil brought in, merged into the the 2 entities merged into the 1 entity going forward. This financing that was done at 9 cents has been used as a proxy to me, or I've used it as a proxy to show people as to how these financing can make a lot of money doing them at the right time and at the right value, because there's a lot of skepticism around some of the most recent financings that were done by some of the junior growth companies. Yet there's a very clear example here of where 750% was made in about 14-month period. Okay, Touchstone Exploration, a company that actually still exists today. So what happened was there was a company called Petrobank Energy, about 25,000 barrels per day. They spun off all their assets except the heavy oil assets into Petrobakken. Petrobakken later became Lightstream Resources, which will be discussed in my part 2 of this type of session. But the Petrobank Energy that got left, aka New Petrobank, was just a small company with some heavy oil assets, and they merged with Touchstone, which was an explorer in Trinidad and Tobago, so outside Canada. And the Petrobank had about 40 million shares. When they merged with Touchstone, another 40 million shares were created, so about 80 million shares total. And here you can see what Petrobank had. They had the existing heavy oil business, some related technologies, and about $100 million of cash and marketable securities. So in all intents and purposes, it was a SPAC. And this was in 2014. In 2017, Touchstone went and started raising money. They raised money at about 20 cents per share and to go and drill some wells. This was December of 2017. They also raised money in 2019 at 21 cents per common share. We're talking Canadian dollars. 21 cents per common share in 2019. And those investors ended up making a 10x on that in about a 2-year period. So Touchstone in early 2021 was trading at $2.60 per share. They had a very successful exploration program in Trinidad, a gas exploration program. And these investors made 10x in less than 2 years. So essentially bet on a 1-well exploration program, which then became a 3 to 4 well exploration program, made really good returns. And they're laughing because the stock price today is still about 6.5x versus what they got in at just about 4 years ago. The financing from 2017 made money, and basically everybody involved in this has made money since the start. They have, as far as I know, they have not raised any more money in the past couple of years, despite the price rising to where it has, and doing really, really well. And the reason I wanted to talk about this was because Petro Bank, a lot of people that would have had legacy Touchstone shares would have had the shares through Petrobank, which was a Canadian company. And they just kept their 40 million shares as time went on. And that grew, that was almost like a free option that got created when Petrobakken and Lightstream was spun out. So you had Petrobank, you got your Lightstream share, which they could have sold or kept or whatever. And then you got this free option on the heavy oil properties with 100 million in cash. They might have chosen to just keep those shares. Petrobank at the time had these heavy oil lands kind of all over Saskatchewan and Alberta, some of which was in the Mannville Formation that we've talked about. Heavy oil, cold flow, enhanced oil recovery in the Luseland property. So this Luseland property is just bordering Alberta and Saskatchewan, and they had quite a few sections here. And then they sold it. They sold it with 42 barrels and 4,000 acres of undeveloped land for about $2.2 million. Touchstone didn't want to focus on heavy oil. They had bigger fish to fry. Okay, great. And they ended up selling it for $2 million. Well, 2 different companies came in today, and now they're in those properties. One is Strathcona Resources, the Waters Energy Fund, Strathcona Resources. They drilled quite a few of these wells up here in this part of Luseland. And they started producing in 2015. They started producing about 1,200 barrels per day. That property today still produces 1,200 to 1,400 barrels per day, with only 7 or 8 wells drilled, very shallow horizontals drilled, and making 1,200 to 1,400 barrels per day of low decline, heavy oil production. Okay. There's another company that came out here, Sojourn Energy. They have these 3 long horizontals. They decided, no, long horizontals is not the way to go. We're going to come in with 5 short, stubby horizontals. So that's what they did in late 2021. They were able to get about 250 to 300 barrels per day production out of these 5 small horizontals. That production has now fallen off because the wells went down last winter and looks like they haven't come back online yet. But production was still staying at about 150, 125 barrels per day at a very, very lower decline fashion, and just staying there for super cheap wells. These wells can be drilled for $600,000 to $800,000 each, very shallow. Stay there. So essentially, the Touchstone Exploration entity, if it had kept these assets and actually developed them, it could be worth 2-3 times what it's worth today. So the shareholders still did really well. They still made 7, 8, 10x, but they could have made even more had they kept these properties, which is the heavy oil area that I've been talking about for the last little bit. One comment on this that I would like to make for my own perspective is the Prospera Energy Luseland property is right here. So if you're looking at this map, this is where the Strathcona wells are. 2017, no, these are, 2017, 2018, 2019. The Sojourn Energy is right here. These are 2021 drills. This is where Prospera will be beginning some of their development program here as the months and years continue. Here is some of the results. So Touchstone announced the Cascadura Deep 1 drilling result in 2020 and hit a lot of gas, hit petroleum, share price started rocketing. And within 2 weeks, they had a deal signed with the National Gas Company of Trinidad and Tobago, which then added more flurry to the share price, which you can see here went basically in a straight up fashion, almost exponential fashion, which is traditional with these junior oil and gas companies. Once you see a really good play hit and oil being produced, cash flows being generated, you can see exceptional return profiles that just continue going. They just continue going. People don't really sell because now the higher valuation is justified, and it keeps going until it hits a peak, and then it does fall from that peak 20, 30, 40% sometimes, and then stabilizes at that level going forward. So that is Touchstone Exploration. I think we're about 7 or 8 companies in. So I think about 6 or 7 left, if I'm counting properly. So the next one, Arctic Exploration. So this is one that Kelt bought in 2015, $370 million. Kelt liked this asset because Kelt already had a 50% stake in the liquids-rich Montney acreage, and Arctic shares jumped 49%. That was a premium paid to $2.61 per share. The actual price that was paid was $2.76, so a little bit of an arbitrage there for those who were waiting to see. And Kelt fell 4.5% to 7.74 on the deal. This is the same Kelt that today trades cheaper than $7.74. So people who bought into the Kelt story at this time have not made any money since 2015, despite the way the cycle has gone, despite the way that they've sold Inga and some of their other properties to Conoco, and the way that they've delineated their lands and created even more value in the company. We're still able to buy Kelt cheaper than it was back then. It goes to show you the hype around the Montney that got created in 2013 to 2015. It was immense hype around the Montney play, and rightfully so. And once again, a comment on high growth companies. For Q4 of 2013, for all of 2013, the funds flow from operations was $26 million. The CapEx was $84 million. So Kelt also was outspending their cash flow by 3 times to go and grow their production, add lands, create infrastructure, create pipelines, etc., in order to fund their development. Their total net CapEx, including acquisitions, was $99 million. So you made 26, you spent 99. Unheard of in today's junior company growth climate, or even bigger companies growth climate. Nobody's outspending cash flow to that level, not even close to anywhere there. So when we look at some companies that are kind of bucking the trend and growing 2, 3, 4%, I'm a fan of that. Not every company should be doing that, but certain small companies that can grow that, great. Certain companies that can grow within cash flow 30, 40, 50% on the junior side, those are, for me, attractive investments going forward. So a quick story about this buyout that some people may find interesting is when I started investing in oil, this would have been my second year in petroleum engineering. So I was about a year into it at this point, year and a half into it. And I had some Arctic Exploration shares that I had bought for something like $250 or $275, something like that. And I ended up using my student loan money to buy those shares. So I thought, okay, hey, my tuition is not due until like February, end of February, I think it was. You got 2 months after the semester started, something like that. So okay, my tuition is not due till the end of February. And I think the funds came in on like January 1st or January 5th. I said, oh, I got a month and a half or 2 months. Like, let me try and make some money in the oil and gas investments by the time we get there. Okay, so bought Artec, I bought a couple other companies, and they didn't do very well. The first couple of months of 2015, prices really started falling on these oil and gas companies. There was mass panic in the streets, and I remember thinking like what am I going to do now? Like take on debt and pay this off, or I'm gonna have to borrow money from somebody, all while I'm looking stupid because I put the student loan money into investments that ended up losing 30 or 40% in a matter of like 6 weeks. And then I woke up one day and Kelt had bought Artec and the shares went up 49%, almost 55 to 60%, I want to say eventually. And I immediately sold all my Artec and paid off the tuition for that semester. And I was like, wow, this is a great investment. Like I made all my money back and I was able to pay off the tuition. And also I didn't have that embarrassing moment of having to tell anybody that this had happened. Of course, now at this point, multiple people know this story just because I find it's funny to share it. But yeah, I think that's really, when people say you have to be bullish on this sector in order to invest in the sector, they're not lying. They're saying the truth. This is not a sector to be downside protecting in and being super cautious on. You really have to have that passion and that uber bullish view on commodity prices and the company's valuations. Of course, within reason. You can't just be a momentum-based driven investor either. You have to understand what's going on, which is what I then spent time doing over the last 7 or 8 years, focusing on that portion of it. But to invest in this sector, there is a bit of passion and cowboyness and just sheer throwing money at it sort of thing that has to happen. Or you have to have that sort of thinking, especially when investing in some of the smaller companies, a belief in the vision and a belief in commodity prices to stay higher or at least go higher from where they are. So yeah, I guess my little story there. And the deal just so happened to be like 2 or 3 days before the tuition was due, because there was a 2 or 3 day lag or something by the time money got transferred. And then once I sold my Artec, I couldn't pull money out for 2 days while you have that 3 day holding period on all transactions. So we got the long run miracle in Christmas of 2015. And for me personally, I had the Arctic exploration miracle in February of 2015. I will remember that, waking up that day and just hallelujah, this sense of relief. I remember that day for a very, very long time. In addition to this, Artec at one point had the Leduc Woodbend pool. So the same Leduc Woodbend pool that now Tenaz Energy owns. So this is what got Tenaz started with the Altura transaction. So essentially, Artec had about 2,200 BOEs per day, a very nice F&D cost. They had all this Montney land. 50% was with Kelt. Some 60% was Artec. 40% was Kelt. In the Inga fire we played, the BC Doig, and then the Cadomin, a deep gas play as well. And mostly natural gas, some light oil, mostly operated as well. And we see some of the shares that were created. So financings were done at $4.10 per share. Those financings lost money, about 40-ish%, despite the huge premium paid by Kelt. And they also then raised money at $4 per share again. And then money was raised at $2.40 in 2011. So these investors in 2011 barely broke even. So after 4 years, they basically barely broke even on their investment. Again, why I say investing in established companies at higher valuations and when commodity prices have already risen may not be the best way to do things. So I almost find it interesting to put it this way, but you can be a perma bull on oil, yet the commodity price is already high, or the valuations don't allow you to invest in a profitable environment. So don't confuse being a perma bull or having bullish views on oil with the right investment climate being there and the right risk reward valuations being out there. Those two things are completely separate. I could believe that oil is going up from 75 to 100, but if companies are trading at 10 times cash flow at $100 oil today already, I'm not going to buy them. There's no way. So two things have to make sense for that investment to really make sense. And here I'll show you the map. Here's Leduc Woodbend today with Tenaz's horizontals here. And here is the Artec wells in 2012. I should say Artec was drilling into the Glauconite. It seems like Tenaz is more looking into the Nisku formation. I haven't looked into it enough to say whether it's the same thing or not. But this field went from Artec to Kelt. It went from Kelt to Altura, and then from Altura to Tenaz in the space of 7 years. So it was too unfocused for Kelt. Altura grew it, but it wasn't big enough for Altura. And then eventually Tenaz took it over about 3 or 4 years ago now, and have further grown production to about 2,000-ish barrels per day plus out of this pool. And you can see the pool map. Here is in green is sort of the outline of the basin, and you can see Tenaz has barely drilled the pool so far. Barely. They're barely getting started, which is why this is a very nice pool for Tenaz to continue getting cash flow out of and continue growing. Okay, I just want to see where we are here. So, okay. Yeah, I can't believe we're 3 hours into this already. Whoops. So Tuscany Energy is going to be our next one, a small producer. Again, heavy oil Lloydminster focused. I feel like a lot of the growth companies in the past have been focused on either the Montney or the heavy oil Mannville channels, which are so prolific and so expansive, and then multi-zone development as well, of course. So Tuscany went under because RBC or ATB pulled their credit line. So $8.5 million became due, and Tuscany didn't have the money, so they ended up going under. They also, in December of 2015, they actually drilled a very nice, successful exploratory horizontal well in a Dinah prospect. So Dinah being in the Mannville channels. And this was done to satisfy the flow-through share commitments. They had to drill this in 2015 when prices were very low for heavy oil. It was a new discovery. It was 6 offset developmental wells possibly being drilled. And the new well produced pretty good, 67 barrels and then 84. And then it got shut in because they had met their commitment. Now they shut the well in. The reason this is interesting is this is how companies used to do flow-through share commitments. They would get flow-through shares, but then they had to spend the money in a reasonable amount of time in order to meet the requirements. But this really hamstrung certain producers who had to spend money in 2015 and 2016, despite prices not being good and the economics of drilling a well not being good at that period in time. Here is the well today. So here is your horizontal well today. And what do you see? There isn't 6 offset developmental wells drilled. This well itself, because it was shut in for so long, suffered from some sort of failure, reservoir failure, where it never came back to the rates that it was producing at in the past. There you go. If somebody's looking for a little drilling project, that's essentially still sitting there. So I can keep giving you examples of these things. The last 6 years, very little has gone developed compared to the actual potential out there in the Canadian junior growth space and the Canadian conventional oil space, especially in Lloydminster Provost in the Mannville formation. And hence why the White Hunter Petroleum entity was launched and why we're going to be focusing on the Lloydminster Provost Mannville stack formation. It just makes sense. There's so much potential here with cheaper to drill, less geologic risk, and lower decline production. And in August of 2015, just before this happened, all this happened, Robert Lamond, who was the CEO at the time, along with his corporations, ended up buying more shares on the public market. And him and his entity then owned 36% of the shares of Tuscany. Talk about putting your own money where your mouth is. Definitely a good situation. You want to invest in companies like this, where the management team is not just buying shares because they are multi-billionaires and so they're buying shares. Like, people give so much credit to Mike Rose and Grant Fagerheim and Bonterra for buying shares. Well, they're just buying shares for the sake of buying shares. They have hundreds of millions of dollars that they have, and they're buying a couple $100,000 or $1 million. It doesn't mean the same to me that other people take it at face value. To me, a CEO owning 25 to 35% of a junior growth company, that is now actual real conviction and commitment in my mind. So really big fan of smaller companies like this. Unfortunately, this ended up going under, but the Tuscany Energy had merged with Diaz Resources in 2013. So there was assets that they were continuously buying. Small company, 405 barrels per day. That's where you make your money as a junior oil and gas heavy oil producer, by growing something from 50 barrels to 500, not from growing it from 2,000 to 5,000. That's, at that point, a lot of the juice is already gone. And it's a lot more work, because heavy oil fields traditionally, medium to heavy oil fields are smaller. They don't have the same growth profile to grow it to tens of thousands of barrels per day. So keeping it small and having longer reserves allows you to get a lot more value out of these than just over capitalizing everything. And then this was trading at the time for 8 cents per share before they had the ATB issue. And fully diluted, they had about a market cap of $4 million. That's it. Bank line of 8.5, the same bank line that got pulled. And so $12.5 million EV. Look at their proven reserves. $30.9 million of proven reserves, 1P reserve. Another undeveloped land on top of that. Abandonment liability, only $1 million. It was a very, very clean asset. So very unfortunate that this company went under. It was a very solid way to be building a company. Just took on just a little too much debt, and it got pulled at the wrong time, which with small junior companies, you don't get as much of a leeway as a Lightstream would or a bigger entity would with their connections. This just got pulled and bam, you're out. And the CEO, Robert Lamond himself, had $464,000 that the company owed him. That got lost along with his investment in the company, obviously. And I love this quote that he put out. He said, after the company had gone under, he says, "I made lots of money and the oil business has treated me really well. Sometimes you don't quite make it." And this is the mentality that allows people to make multi-millions of dollars and hundreds of millions of dollars and generational wealth in this industry. You cannot dwell on how the oil cycle went against you, or one drilled result went against you, or you had some sort of issue where you had a spill on site and it hindered your progress. If you're the kind of individual who dwells on those things, you will not be successful as an oil and gas entrepreneur running a company or being a significant major investor in a company. That's just the reality of it. You have to have this mindset of, okay, I got pushed on the ground. I'm going to pick myself up, dust myself off, and here I go again the next day in the office looking for prospects, looking for deals. So just a fantastic mindset to have, one that I personally really can relate to. Not that I've really accomplished anything under White Tundra Petroleum yet, but I think that's really the model that I'm going to be running is very similar to this sort of model here. And the other comment that was made is, if you have too much debt in heavy oil, it can be dangerous, as we have found out. There you go. Blunt, to the point and back at her. Actually, the reason I find this company fascinating is because myself and Sohaib, we met Robert Lamond when we went to Louisiana for the energy conference just a couple of months ago. So still out there, still looking for deals, still looking to find out about the junior company space. 7 years after this, all this happened. So great. And here is some of the wells that were owned by this Tuscany Energy. We can see they brought it up to 300 to 400 barrels per day. In 2015, it was trading at about 400 barrels per day. Gone. By 2017, it was zeroed. The assets got took under by the creditors. They didn't do anything with it. It just got let go. And then a company, Longshore, came in, Longshore backed by Arc Financial, bought the assets and just left it. They didn't do anything with the asset. They just left it there, didn't do anything with it. In mid-2019, when oil prices were $60, $65 a barrel, they came in and all they did was fix up the wells, whatever needed to be fixed, whatever didn't need to be fixed, still sitting there. Brought it back online along with a couple of new drills. Well, bam, 350 barrels per day from zero overnight. That's what these fields can do. And this is how the field was developed at the time. This is how the field is developed today. So you can see these initial horizontal wells are still here in the back. These couple of horizontal wells this way are over here. And there's a few new wells drilled, but you can still see the pool. The pool still has multiple drilling opportunities in the bottom part here, in the northwestern part here, and then possibly even in the northeastern part on this side. So it's all still there. And Longshore still owns the entire pool. So sitting there, happy. They got it for super cheap and they waited for prices to recover. And now they make money off it. Similar other pools still sit today under creditor protection. Similar pools still sit out there today within bigger companies that have not capitalized them. And similar pools still sit today in junior growth E&Ps of today's environment, waiting for higher prices. And even certain development plans are going ahead even as we speak. And here's your Dyna sand. So you got the oil zone. You have underlying water. Always want to drill at the top of the zone to keep your water intrusion to as late as possible. You can drill vertical wells, you can drill horizontal wells. Here, once again, you see the sensitivity on these wells. So at $50 US WTI, 1.5-year payout. At $70 US WTI, 0.5 years payout. At $90 US WTI, maybe a 0.3-year payout, maybe 0.25-year payout. Therein lies the secret sauce as to why heavy oil is such a good startup package for junior oil and gas companies, and also such a good starter package for established oil and gas companies, because you can grow production very fast, but that production that you grow is low decline. It doesn't have the Viking profile. It doesn't have the shale profile. It has a low decline asset that you can grow very fast, and at some point might be water floodable. So, and then all of this had 3D seismic on it. So here's the other asset that that they had. This is the Macklin asset. If you look at this pool just to the right here, all these vertical wells, 39 of 28 W3. This is the asset that I operated and did field engineering for in 2018 to 2019 for Prairie Thunder Resources. So very, very familiar with these areas, and the same assets just keep showing up in my life over and over and over, which I really enjoy, because you already have a in-depth understanding of them, having been in the field, as opposed to some asset that I've never worked or have never operated or have never been to. Another thing I liked about Tuscany, they shared what they were doing as complete, passionate entrepreneurs in the oil and gas industry. We want to share what we're doing. I cannot believe there's companies out there that are so shy in sharing what they're doing, what kind of wells they're drilling, pictures from site. Like, what are you trying to do? Just make money and then that's it? Like, live under a cave? I mean, all the power to you, but I can definitely relate more to companies that are sharing their vision. They share the story. You can see the pictures. Here's a PCP pump, progressive cavity pump. We used to operate hundreds of these out in the Macklin field. This one's on an electric drive, so runs off grid power. You can see a couple of tanks in the back. These look like 1,000-barrel tanks. So each tank can hold about 1,000 barrels, with looks like what would be an underground pipeline going to it. Likely both are oil tanks. You let the water sit. The water drops out to the bottom. You pull your oil from the top of the column and sell it and make lots of money. And pretty simple operation. Here is a battery. So this looks like the Evesham battery that they had. Way more tanks. The black tanks are usually oil. Blue tanks are usually water. And then the green tank is usually emulsion or a recycle tank. So if one of the trucker is pulling oil and he said, oh, no, there's too much water in this oil, you can go and dispose it in the emulsion tank so it has a little bit more time to sit. And the emulsion becomes oil and then water, more retention time, I should say. These little side-by-sides were very popular in that area because of the way the soil was this clay-like soil that just stuck to your truck. And it was very difficult to drive in those sorts of conditions. And we always ran propane, excess propane, so that if your grid power for any reason stopped, you could switch your wells, not all of them, but you could switch some parts of your operation to propane and continue on. So very gorgeous area of the world, the flatlands, a lot of farming in this area, lots of cows and horses and bulls, pretty cool little area. And then here is the same, I believe this same battery, Evesham battery, could be a different one, but you can see a little bit bigger tanks even here. And with their containment on them, you can see 2 well sites in the back here, and then 1 well site in the back here. And there is Robert himself, the CEO on site, checking over the operations. So I guess I'll just make this point. We have lost a lot of people over the last 10 years with the passion and drive of being a CEO of a company, but also going on site and looking after the operations, taking pictures with your arms stretched out like that, proud of what you've built. We've really lost that, unfortunately, with the batch drilling and the shale and a lot of finance type people who have come into this sector, which is great. All the power to them. But I'm really looking forward to, hopefully, with these videos and with the White Hunter Petroleum entity and whatever else I've been doing, my initiatives, to bring more super passionate people back into the sector, people who literally live and breathe oil. When they fall down and their knee gets scraped, they don't bleed blood. There's crude oil popping out of that. Those kinds of people I really relate to, and looking forward to kind of having more. In fact, through these initiatives, I've actually talked to now two individuals who are still doing their studies at the University of Calgary, in order to connect with them and kind of guide them in a sense, to the extent possible. And I had one more reach out to me just a couple of weeks ago. So I'm looking forward to kind of keeping that part of my initiatives up as well. Okay. So next one, Hawk Exploration. So Hawk Exploration merged with Kaizen in 2016. You can see how it took some of these companies till 2016 to go under. It's not oil price went down and in 6 months they were gone. Yes, there were companies like that as well, but some of these companies survived a lot longer. And so again, take a look at your risk profile that you're putting on any company in the oil patch. Make sure it's realistic. You're not overstating the risk just because you haven't done the full amount of work to figure out what is the risk profile of this company, especially ones that have term debt that's termed out to many years down the road. So Hawk Exploration, they had this. They had high cost oil production, so they shut some of it in, couldn't get it back. And essentially the credit facility got reduced. It went from 13.5 million to 11. And that just created more problems for the company. It required a principal repayment of $2 million by December 2015, and then $2 million on May 31st, 2016. The first payment was made. Second payment could not be made. Well, bam, May 31st went by. June 1st, it got acquired. They had some really nice hedges. This is super interesting to me. They had 100 barrels per day oil hedges at $104 Canadian. And then they had 100 barrels per day oil hedges at $21 Canadian. That's how fast. That $21 hedges on the differential on the Canadian, and then they had the same hedges at $73. So a $30 difference in 6 months. That's how fast the price collapsed, and that's how they were lucky and able to survive for a little bit longer, but the price just kept collapsing. By early 2016, the price of WTI was $30, $35 a barrel. No company was able to survive past that. And once again, incredible net asset value. So the 2P reserve asset value, after accounting for debt, 83 cents a share. It got bought out 8 cents per share. Some companies got a hell of a deal on this. And this Kaizen Energy actually did very little with the asset. They kept the asset as is, and it was recently acquired by a company called Courser Energy about 12 to 18 months ago. So the people that had money that were waiting for the cycle to turn, they ended up making some really good acquisitions in 2021 and 2022 already. So some of the assets are already gone. That being said, what makes Mannville Place so cool is that there is incredible upside to development and horizontal drilling and also exploration in this area. So there can never be too many chefs in the kitchen. There can be at some point. In today's world, there's barely 25% of the amount of people that the Mannville, Lloydminster, Provost area can allow to come in and collaborate and all build companies at the same time. So a lot of potential still there. I hope the Twitter space didn't cut out because I just missed a call, but should be still running now. We should be back at it. G&A, again, $4 per BOE, a little too high, and took some of these companies under because they just had so much expense. As they were growing, they had a team bigger than what the assets required at that time. And the bought deal placement by this company, Hawk, was done at 80 cents per receipt in 2011. 5 years, lost 90% of the value, despite all the good things that the company did. When valuations get out of hand, when the commodity price has already gone up and multiples are reflecting what you as an investor think is fair, keep in mind the risk on what you're doing is a lot higher than the risk on investing at something at lower prices and lower valuations. There's always that, what's the upside, but how much downside am I taking on to accomplish or take on that bet towards the upside? And a proven management team. They made 350% after tax on their first venture, 3,000 BOE per day. They made 454% after tax in their second venture, Hawk Energy, added 2,400 BOEs per day. The third one, unfortunately, went under. You can see a lot of their assets, even in 2014 or 2015, were vertical heavy oil and vertical medium oil. They had not hit these assets with horizontal drilling. Here is one asset you see, all verticals. Even today, some wells are operating, the black dots. Some are in suspended status, and then some are abandoned, as we see here. This area could still be pretty profitable with horizontal drilling at higher oil prices. Look at these horizontal drills here, just at the edge of the asset package. Look at how many wells are spaced in so close together, and how much oil is still to be extracted between these vertical wells. It will require much higher oil pricing, but the opportunity still exists in completely delineated fields with hundreds of well control and well logs already in the area. Here is a different pool. This was the, I believe, the Yonker pool that is being discussed here. It is, okay. Yeah, so this is a McLaren pool. It produced about 350 barrels per day out of 4 wells and then just went under. So wasn't able to be re-brought back online, and the wells were subsequently, I believe, abandoned. So at this point, it just sits there. One of the issues with ARO, this is one of the issues with ARO, is when the government pushes too hard for you to reclaim and abandon wells, you might end up losing wells that were actually economic at $70, $75 oil. But because oil was 50 in 2016, 2017, 2018, and you had to spend money on ARO, you lost money, you wasted money on the ARO, and the government never got the benefit of the royalties because that well was still economic at $70 oil. So I'm always careful with pushing ARO, with governments trying to say, oh, you have to reclaim this much percentage of your ARO, because some wells are not obligations. They are good wells that just at that point, that company could not produce it in that pricing environment, or they couldn't fix it if it went down in that pricing environment. Very, very unfortunate, but also a huge opportunity for people willing to do the work and find where these wells got abandoned and then drill next to it new vertical wells. Here is some of the acreage that they had: Yonker, Neilburg, Baldwinton. You'll see when I say there's a lot of exploration potential here, this is why. The companies in this area don't just develop properties. They develop and they explore. And they go and buy sections all over the place. You can drill vertical wells, you can drill horizontal wells with exceptional returns on them. Here's one well that was drilled by Hawk, produced a bunch of oil there. And we see now next to it, in 2022, we're seeing multilateral development take place and horizontal development take place. This one, I believe, is a Baytex well at this point. So certain companies are early in the curve. Certain companies are still waiting. Lots of land here still to explore and develop. Here is the same map as what Hawk Exploration put out at the time, right here. So the same section up here is where Baytex has drilled. I believe, actually, no, I believe this is the Yonker acreage right here. So this red pool here that Hawk Exploration had and never drilled, Baytex has now come in the exact same area and drilled it. This we're seeing one of the other acreage that Hawk had. I believe this is this acreage here. And the green are the new drills. The red are the workovers. And then the stars are some of the exploration wells, if I'm not mistaken here, as to what they wanted to do. So still lots of things they wanted to do when they went under or got taken over. And now Corsair Energy will come in and make the money off what other people couldn't. And some really good wells. Cumulative oil, 140,000 barrels. If you have that in an $80 oil environment, it'll net back about $50 to $60 per barrel Canadian. You can make $6, $7, $8 million out of a well that cost you $700,000 to drill. These are vertical wells. So people like heavy oil for a reason, because if you hit one well out of every three, over time, you will still end up ahead. Whereas with the Viking or with the Montney, if you're hitting 60% of your wells, you may still end up making very little money at the end of that all. So this area in the Mannville is very conducive to exploration, especially with vertical drilling. Really, really good to go and expand your acreage. And you can see multiple sections with no drills in them. So 1 mile by 1 mile areas, maybe 3 miles by 3 mile areas with not a single well drilled on them. These pools are small. You could have a pool that's 2 miles by 1 mile. That's it. And you could produce maybe 500,000 barrels out of that tiny little area, maybe 1 million barrels out of that tiny little area. So a lot of exploration opportunities still remain. Okay, we have Altura. So the company that Tenaz bought, Altura bought the lands from Kelt, as we discussed earlier here. So all came as a package in a sense. Altura got bought out by Tenaz in October 2021, and there was a new board of directors and a new private placement that got created. And we can see the Altura management team, the CEO and the VP engineering of Altura took different paths. The CEO of Altura, because he had experience with Vermilion already, is now the SVP engineering at Tenaz. Great. The VP engineering at Altura was the VP of engineering at Tenaz, and now is a senior development engineer at Tamarack Valley. So one stayed with a small company and became a bigger role. The other didn't enjoy that and went back to just a development engineering role with a bigger producer. This junior company game is very interesting if you're going to do it as a career versus as an investor. Because if your company doesn't get bought out at the right premium and you don't like working with a new team, you might have accomplished nothing despite discovering pools and working a lot of hours in a startup-like environment, and just go back to kind of your regular career that you were on. Others, you can make 7, 10, 15, 50x in a period of 2 to 3 years. And now you just went from an investor to now becoming some sort of venture capitalist as your lifestyle. So a lot of it depends on where the cycle is and when you get in and how much money you can make on that cycle as a core member of a junior oil and gas growth company. Because Altura discovered the Leduc Woodbend, yet the management team didn't really get the benefit of that, given kind of how things panned out. They discovered the Sparky Manville, the Sparky Formation in the Upper Manville, and then the Nisku as well. They were doing other acquisitions of land. They raised money in 2015 as well. And this was a net cash company. Altura in 2016 had net cash of $22.1 million. So a very unique junior in that sense. And just kept growing production. And what they said was they wanted to establish the corporation by acquiring land when land prices are at a 20-year low. So 2015, 2016, land prices were super low. Companies that had the right mindset came in, they bought that land, and then started growing it slowly, expecting a rebound that never came until 2021 and 2022. So even companies that bought stuff for super cheap ended up going under or making no money. And then they got bought out by other companies in the last 2 to 5 years. The shares that were issued at the time were at 18 cents per share. And there was then a 10-to-1 consolidation again. So $1.80 is what the private placement participants paid. The placement participants on the original Altura creation paid 3.3 cents per common share. Then that got put up into a 10-to-1 consolidation. So they paid 33 cents for their shares, which today are trading at about $3.50. So they ended up making a reasonable amount of money. Hang on a sec. The 644 million shares. Yeah. So they ended up making about a 10x, but over that entire time, and they really didn't put enough money into this. The new management team and board of directors only put 3.2 million. So over time, yeah, they made a lot of money on it, but individually, it didn't pan out to be enough of a gain for them to really have made the sort of gain that would really transform your career or your lifestyle. And so 2 share consolidations. And I don't have the full information here, unfortunately, but I believe there was a second share consolidation as well that happened here. So essentially, this management team, I believe, if I'm not mistaken, ended up not making that 10x that I discussed. So I'll have to go back and verify this, but I believe there was a first 10-to-1 consolidation, and then there was another 10-to-1 consolidation after the fact when Tenaz got in. So essentially, I believe this management team ended up making no money, but I will verify that on the next part 2 of this setup. We see here once again the Manville zone, Upper Manville, under which lies the Clearwater. So the Upper Manville, and then you have all your zones within there that lie in the Edmonton area. As you go east, you lose some of these detrital beds, and it transitions more into a Sparky and a Rex and Lloydminster and Dinah play. Here's little bit more about the Manville Formation. So we have the Clearwater oil targets, we have the Provost-Lloydminster heavy oil belt, and then you have your sort of stacked pay more in the deep basin of Alberta. But once again, the Clearwater oil has been identified for many, many, many years. It just required the right oil price to go and companies to take that risk and produce that. So you or we already have a prime example of the technologies in the last 10 years changing, but not having been capitalized properly until recently. I guess Spur was in the Clearwater earlier, but not as public about it. Here is the Rex pool outline that Altura found. And then here are some of the original wells ever drilled in Alberta. So the Leduc number 1 and the Leduc number 2 targeting the Leduc Reef. And then the Rex pool here that was discovered after the fact was just underlying that same area. We can see here how that underlies. So the D3A Leduc pool with almost a 60% recovery factor, 252 million barrels produced out of 385. The other Leduc pools, a little bit less, but still huge oil in place. The Upper Manville pool, 1.16 billion barrels of oil in place. However, it is a frac play. The permeability is not like the Leduc Reef was, and the porosity is not like the Leduc Reef was, but original oil in place and the cumulative to date, it goes to show you why Tenaz is on such a great path, and also one of the companies that has had the best year-to-date performance so far this year, but in a junior manner. Biggest fields discovered in the last 40 to 60 years in Alberta. You can see the OOIP. Altura discovered the 11th biggest field, and technology is a reason why. Same with Upper Charlie Lake technology, Sinclair technology. These new fields that are being discovered are mostly technological advancements as opposed to a geology discovery. And then we also have the halo fields. Halo field meaning you have a core production of oil, and then now we're able to drill on the outside of it and kind of expand the field because of horizontal drilling or fracking. We're able to hit the lower permeability areas. And you can see every discovery on this that's recent, halo or technology. So any field that's big enough is going to be discovered using these things. And we have multiple ones that have technological advancements on it as a primary reason why these fields are now able to be drilled and produced. Top discoveries, more than 300 million barrels. You can see only 5 have happened since the 2010s. The rest have all been in 1950s, 40s, and 60s. We are running out of big, huge producers of oil. The discoveries I've talked about so far in the junior growth space, and I say, oh, there's a lot of exploration potential, there's a lot of potential to grow production. I'm talking in the small, very small space. Grow from 500 barrels to 2,000 barrels, yes. But as far as pool discoveries that are 300 million barrels or bigger, very, very rare. And therefore why our supply thesis is so strong on a structural undersupply, yet you can still make a lot of money on the junior oil and gas space by targeting smaller and more enhanced oil recovery kind of fields. And it even tells you that the discoveries of the 2000s and 2010s, were they really discoveries? No, because most pools had uneconomic vertical producers. We don't know when the vertical producers targeted the zone, and the first horizontal well was the first commercial or economic success. So literally horizontal drilling is what caused it. We're now into the lower permeability pools, which is why they have to be fracked or extensively stimulated. You can see the fluorescence on the oil or on the rock that was found. So I may have shared this before, but this is just at 1405 meters straight coal, at 1415 sandstone, and you can see how it glows under UV light because it's oil. And then as you go deeper, you can see it's glowing even more and more, meaning there's more oil content and possibly even higher porosity as we go deeper. And these are the kind of tests that are done to find these fields. Relatively simple, nothing really too crazy going on here. And I'll leave this for the people watching on YouTube, but some information on the pool itself. You can see the permeability the viscosity about 100 to 200 centipoise. So still relatively mobile oil. And then you have your permeability is only 1 to 10 millidarcy. Relatively tough to go and produce this without fracs. To produce something without the frac, you have to have something like at least 100 millidarcy. Maybe we're talking 2 to 300 millidarcy. And then we have some pools out there still today with almost 1 Darcy rock, maybe 2 Darcy rock. Absolutely phenomenal fields with low recovery factors. So I don't want to go and give away all the secrets, but watch for pools like that and how they get developed here in a bullish, higher oil price environment. A little bit of information on the drilling portion of it. A little bit of information on the artificial lift system. So you don't just produce a well, your first well, and then just go to batch drilling right away. There's changes that are made. You look at the pump that's put in the hole. You look at the kind of horizontal length. You look at the different kind of perf and frac. We look at the different kinds of operating environments that we're in. And they ended up finding that PCPs work the best because PCPs can handle solids a lot better than a pump jack and a lot better than an ESP for sure, electric submersible pump. And then the ESP or the PCPs are better for high viscosity oil. That's always been the case. And they can carry sand up the formation as well a lot better. So definitely a patience required on these new pools. We keep coming back to that same point. It's going to take higher oil price and a few months for the companies to properly find the best way to go in and produce these reservoirs in a higher price environment. Okay, Spartan Oil. Only one slide here, but Spartan Oil was the earlier entity of Spartan Delta, and even before the Spartan Energy that was bought out by Vermilion in 2018. So the second entity, I believe, of the Spartan Group. Yeah. And it was bought out by Bonterra for all shares, but $480 million for 4,500 BOEs of Cardium. Over $100,000 a flowing barrel, once again. And a really nice transaction. And Spartan agreed to this after they rejected another offer from Pinecrest. Just days before, they rejected an offer at $395 million, and they ended up taking a $441 million offer from Bonterra. So the bidding wars in a bull market get super hot. When companies are running out of acreage and they don't have drilling locations and they know that they can pay up for it and still make money, the bidding wars get super hot. Which part of the bidding war do you want to be on? Do you want to be on the acquirer side of it, or do you want to be on the acquired side of it? Subjective, I personally would rather be on the acquired side of it because I know I have the inventory. If I'm buying in a higher market and paying premiums, you know your company has poor inventory. At low prices, every company should be buying. At low valuations, every company should be buying. At high valuations and high commodity price environments, the only companies buying are the ones who either want to empire build for no reason or ones who are suffering from inventory degradation and loss. And something that's very interesting here, Spartan Oil got created the same way Logan Energy got created just last month, where Spartan Exploration got bought out in 2011, and Spartan Oil got spun off in the sense that Spartan Exploration shareholders got a cash payment, a share of Explorco, and a warrant of Explorco. Sounds exactly the way that Logan got spun out of Spartan Delta. And the Spartan Oil also did another raise at about $4.40 per share later on down the fact. And these Explorco shares were essentially free for Spartan Exploration shareholders. So they made money on it. The Spartan Energy was bought out at roughly, I believe, 10 million shares of that. So I want to say about $5 a share is what Spartan Oil got bought out at, and they essentially got that the whole thing for free out of the Spartan Exploration spinoff. And then the warrant was a chance to buy at $1.49. So even those who exercised the warrants got a 3x, just over a 3x in about a 3-year period. So a really good deal here. Maybe a hint as to the way that Logan Energy is going to go, given the success this team has had in the past. Those who participated in this raise barely made money. So the Spartan Oil syndicated raise at $4.40, they maybe made $4.80 or $5. So 10 to 15% over a couple of year period. Villanova Oil, private company. I don't have all that good information on this, but this was bought out by Legacy Oil and Gas in 2013. And then Legacy itself was bought out by Crescent Point in 2015, I believe, 15 or 16. And they bought these for $108 million in cash and 14 million Legacy common shares. This was the third entity from the Rock Resources team that ended up making lots of money. So Villanova Energy, Villanova Resources, and then Villanova Oil all ended up making lots of money and got bought out by each got bought out by roughly $60 to $80 to $100,000 a flowing barrel. So quite good. And then they now have obviously recapitalized under the Rock Resources brand and are running the company now with a very similar sort of model. Okay, Iron Bridge Resources. I think as we get to the end of this, another reminder, anybody on the Twitter space that would like to join for the Zoom visuals, please join at whitetundra.ca, scroll to the bottom under events, and you can join us for there. And we're just about wrapping up here, getting to the last few companies and sort of go from there. So yeah, so Iron Bridge Resources, a company that was very, very profitable for me in 2018. They got bought out by Velvet Energy. There was a hostile bid made in May. The bid was not looking like it was going to be accepted. And then a second offer was made in June or July. That was a sweetened offer that was then accepted. So I had a lot of Iron Bridge shares because I used to work for Velvet. And when I used to work on site in the Montney, I realized that there's a lot of potential in this Gold Creek area. And RMP at the time was crisscrossed with our lands, and RMP became Iron Bridge. And I thought, okay, well, if Velvet really wants to grow their production in Gold Creek, they're going to have to buy out Iron Bridge at some point in time. So I left Velvet in August of 2017, and it took about a year for my thesis to play out. But I had RMP shares when they were like 45 or 50 cents, and the buyout ended up being at roughly something like 80 cents plus. So in 2018, when almost every company lost money, I was able to really make a bunch of excess cash, thankfully. So essentially, they had the Gold Creek well economics, 6.1 million NPV, very expensive wells, but still really good IRR. This Gold Creek well has now transferred into Crescent Point. It went Iron Bridge, Velvet, Spartan Delta, and Crescent Point in the span of 5 years. So 4 different companies, exceptional asset. In 2017, a new management team came in place. They sold all the non-Gold Creek assets and really started focusing on the Gold Creek, but they messed up. They drilled the wrong kinds of wells. They drilled, and I'll talk about this here as I go, and they drilled not a good situation here. And then end of 2017, they sold a lot of their 2P reserves and focused everything on Gold Creek, but were not able to fight off the takeover for reasons I'll discuss here as I go. They also were one of the first companies to launch a crypto mining pilot. So we talk about power gen now, natural gas being used to feed the electricity grid. Well, in 2018, in 2018, the Iron Bridge had a crypto mining pilot that actually, I think, made a lot of money. There were some entity that came in and bought their natural gas on site, installed a huge generator, and was mining Bitcoin out there on site. And the nice thing is it's super cold out there. So you get natural kind of AC as opposed to some of the other operations that are running in a warehouse somewhere in a warmer climate. So pretty cool little setup. The first initial stage getting us to our power gen units that we have now. Yeah, and actually what was interesting about this is whether it made money or not, I don't really know, but there was a huge pop on the share price when this news came out. So people were definitely watching these stocks even back then, looking for opportunities all over the place. And Iron Bridge had about 50,000 acres of Montney land. Montney land in this area by the time had gotten up to $3,000 to $5,000 to $7,000 an acre. You run this valuation on it, just the land was worth $150 million. And Velvet bought out the entire thing for something like $120 million. Iron Bridge first two wells were 75 stages. Velvet at the time was drilling 145 stage wells. Much better frac spacing, much higher proppant intensity. And the other mistake Iron Bridge did was overbuilt infrastructure. They built gas handling for more than 3,000 BOEs. They built oil handling for 2,800 barrels per day. They never got to that production. And then they eventually ran out of money in 2018. You can see how the lands are crisscrossed. The yellow and the purple. It's difficult to drill wells in an optimal manner if you have random sections in a checkerboard pattern with your competitor. So one had to buy out the other. Velvet was a much bigger company, and that's where the thesis came that, okay, I'll buy Iron Bridge, and then they will eventually get bought out. Here's some information on the Montney pay zones. So 45 million barrels of oil per section. 1 mile by 1 mile. So 1 square mile has 45 million barrels of oil in place. Very, very nice reservoir, very nice net pay, good porosity. Permeability is your shale permeability, and then 15 wells per section. So pretty tight spacing. Whether they actually do that, we'll see, but pretty good. And here's the mistake that Iron Bridge made. They did not drill long enough, and they did not frac this with high enough intensity. And it makes a major difference in Montney wells. The purple and the red is the Iron Bridge wells. The green and the black was our Velvet wells. And I remember we were making 5, 6, 7, 800 barrels per day out of these wells. It was just fantastic, fantastic performance. So that's the only difference. If Iron Bridge had drilled longer and fracked them harder, they might have still be around today, because they would have had the money to continue on, but they just ran out of cash and the company got sold. Can't really blame anybody because all this was still in its very early stage. And then Iron Bridge / RMP didn't really have the money anyways to go and spend the kind of money that Velvet did. Velvet spent $2 million on just frac sand per well. And the frac was extremely expensive compared to what RMP paid. At least from what I remember being in the field level. So sometimes they must have thought, okay, let's just drill it a little bit less, frack it a little bit less, but they got proportionally much worse performance out of the well. And that's how it is. Here is some of the information on the different wells, and then Velvet's wells on the side. You can see the Packer stages, 133 stages on the Velvet initial well, and then Iron Bridge was only running 32 stages on their initial well. They moved up to 80. Velvet went up to 145 or 160 stages at a certain point in time. And then also Iron Bridge was using ball drop systems, which did not work. Sliding sleeve ended up working a lot better and much better performance on these wells. And yeah, so the cash consideration was raised to 84.5 cents per share, 13% over what they had initially said they would give. $140 million transaction, a 78% premium. This is where the money was made. I woke up one day and I said, hallelujah, well, bam, today we're going to be eating steak dinner tonight. So definitely have gotten lucky on a few of these, but there was a strong thesis on this as well. It wasn't just randomly buying whatever and then you got lucky. No, there was certain companies were bought. Initially, the management team had rejected the deal, but then with a 13% additional premium, they accepted it. And the reason that Velvet kept giving was the continued operational underperformance. Well, what the Iron Bridge shareholders knew was the operational underperformance would be solved. because they now knew how Velvet was drilling their wells. They had that information, just couldn't last long enough. And that's kind of all she wrote. That's history. Iron Bridge also running very high G&A, $6 plus a BOE. So definitely not going to be sustainable over a longer period of time. And Iron Bridge was actually net debt zero. So they had very little net debt, maybe $6 million on a $140 million market cap, and they still got taken out on a hostile takeover, just because the management team did not have enough of a vision on the company, and it was just easier to sell at that point in time. They also held a $9 million share investment in another company. So again, we come back to companies owning shares in other companies, and also suffering from constraints. So they didn't have the right water disposal capacity, so their wells couldn't produce properly, which means they weren't making the cash flow that a well at 100% runtime would make. Velvet came in and fixed all these issues right off the bat and made money off it. Here's the increasing frac intensity, tighter frac spacing graph, and then the graph on how much oil that makes. It was relatively obvious. Reduced stage spacing, higher frac intensity, a lot higher frac intensity was required. So tons per meter, we went from 0.5 tons per meter to 2.5 tons of sand per meter, a 5x increase in frac intensity, and then the stage spacing went up almost 4x. So, or went down almost 4x. So definitely a very conservative frac that was put in by Iron Bridge. Velvet went the other way. They overfracked it and they said, okay, great. We got proportionally better results, way better results. We're going to continue with this. And that's it for today. So that's our 15 companies that we're going to cover today. I'll just quickly scroll through the other few that are going to be coming up here in part 2 and then part 3. So Strata Oil and Gas, Traverse, Questair, Yoho, Strategic Oil and Gas, a very interesting company, High North Resource, Arrowe Energy, Lightstream, Echo X Limited, Conacher Oil and Gas, Bankers Petroleum, Point Loma Resource, Bayshore Petroleum, Raging River, Pinecrest Oil, Novus Energy, which was another very interesting play, Pace Oil and Gas, Charger Energy, Engel, Zargon, Donnybrook, Penny Pony Petroleum, and those are about 21 so far that I've figured out of the next 30. I'm going to keep it to 15 on each presentation, and then also have some historical information as well, some quotes, some interesting share price charts, some interesting narratives that used to exist back then, the thesis that used to exist back then. And yeah, I think this is really good because I was thinking about doing 20 or 25 companies, but I definitely would have ran over on time and it just would have been too long. So yeah, I think I'll kind of wrap it up there. Hopefully everybody enjoyed, not just from a curiosity perspective, but to help you in your investment decisions as to what sort of assets end up or have the highest potential from they don't show up in reserves, they don't show up in the real asset base of the company, but have a lot of upside going forward because the assets are the same. It's just that the technology has gotten better and the pricing environment has gotten a lot better and hopefully continually gets better going forward, which drives even better netbacks and economics. So with that, I think, let me see if there's any questions on it. Yeah, I guess I can do a little bit of Q&A and then we'll wrap it up. So always appreciate everybody's time on this. I love chatting about this. I could chat all day and just keep it going. But I think this 3 to 4 hour session, I think is good. It's enough that there's the detail of information that I want to get out. And then it's also not too overwhelming, at least if it's on YouTube, then you can kind of rewatch it if needed. So there's a couple messages here. You've mentioned Prospera a few times. If you were to do this review 10 years from now, what would you anticipate saying? Well, as an investor in this company, this is not investment advice. As an investor in this company, I hope to say that we were sitting on a multi 100% gain on not just the stock, but also the warrants side of things. And I don't think it's going to take 10 years. If you have a bull cycle, these kinds of high original oil in place pools with high recovery factors can get delineated and produced very fast. The production growth can be pretty big, especially in pools like what Prospera has, where the infrastructure is already in place in 2 of the 3 pools. And I believe even in the 3rd pool, it's enough that they can grow at least to some percentage point from here and extract the oil that's in the ground. So I hope to say that I made a lot of money on it. And I also hope to say that Prospera got bought out. I don't want Prospera, once they're up to almost peak production, this company should not exist. It should sell as a, look, we have this many barrels and we are going to sell you this with a 10-year or a 5-year peak rate here, given that the reserves you have. We also are going to sell it with a polymer flood already in place on a portion of the field, or maybe half the field. And then you can, as the buyer, grow it at the pace you want to, because that's what makes money. If they don't end up selling and they just want to keep growing and growing and growing, I think there's going to be the risk that you take as an investor. Do you want to keep holding on to the company, or do you want to sell the company at that point in time? So that's kind of what I hope to say from the review. At the end of the day, what other technologies are going to show up at this point in time? I don't think anything else is going to be economic till $150 to $200 barrel oil. Like, once you have your primary recovery verticals, plus horizontals, plus infills, plus water floods, plus polymer flooding, if you can get to 35-40% recovery factors, it then becomes very difficult to have something be economic enough to produce the rest of the oil. And Prospera is also working on the nanos. So with the nanos, maybe you get 45% recovery. I'm just throwing out a number over a 10-year period, maybe less. But let's say you get to that. After that, to produce the rest of the oil is just incredibly inefficient and uneconomic. So you don't want to stay in these fields for too long. By the time they're already getting overproduced, let's say 22% recovery factor, at that point you're really going into a terminal decline sort of phase on your production. So that's what I hope to say in a couple of years on this. But Prospera will be covered in my newsletter every month, so you will get my latest opinion and insight and updates as we go on. So, okay, yeah, good. We're staying on the junior company theme, I guess. So 3 questions on Razor. Doug has quoted Razor's break even at $70 oil with some well reactivations. Your thoughts? Let me ask you the question back. If oil stayed at $70 per barrel for the next 5 years, is that why you're investing in Razor? Or are you investing for a higher oil price environment? Can they survive at $70 oil for the next 5 years? Yes. Can they survive at $65 oil for the next 5 years? Yes. Can they survive at $60 oil for the next 5 years by just not putting money into production and letting production decline? And they have a pretty low decline. Yes. Can they survive at $55 oil by not putting money into capital and also not doing workovers and also maybe selling off a portion of working interest in their asset? Yes. So whenever somebody asks me about break-evens, I ask you back, what exactly are you trying to ask? Like, the break-even number, if it's 60 or 70 or 50 or 80, what is it really telling you? And I have my own interpretation on it, but since we're on this platform anyway, I'd love to hear back from you on that kind of part of it, because I'm not investing for the break even in a company like Razor. I'm not investing to try and downside protect in a company like Razor. And I think if it stays there, I will not be happy. Oil price at 70, I could have made more money in other producers. Obviously, given the share price that that company has gone through over the last 16 to 18 months. If WTI goes to 85 and just stays there, is it possible for them to get to EOR without issuing shares? Yes. Yeah. This company has significant torque to the price of oil. And would they go and implement a CO2 flood at 85? Likely not. No. Can they get there? Yes. But it would take 12 to 24 months of oil staying there for them to do that, because CO2 flood requires a lot of upfront capital that you don't get back right away. So their other drilling prospects might be better economics at 85 versus running the CO2 flood. At $100 oil, okay, now you run the CO2 flood and you get all that oil. But the CO2 flood is almost better to do after more drilling, in a sense. If you have a few horizontal drills and a few injectors and producers, maybe you can get much better return on your CO2 right away by doing it that way as well. Is a private placement net profits interest on a working interest partner an option here that might sidestep the public liquidity issue? Yeah, you could, but I'm not interested in a working partner here. No. I think the barrels in the ground are way more profitable than giving away a working interest at this point in time. If there's a working interest such that somebody builds the pipeline, the CO2 pipeline, and then Razor has to sign up for some sort of like take or pay on the CO2, that sort of partner, yes. Somebody coming and buying 50, 60, 80% of the pool in order to fund the capital for the CO2, no. That literally kills the upside of the company overnight to do that sort of deal. So I think some of us get a bit too caught up in like funding everything right away. I can guarantee you this from my perspective, in $100 oil environment, everything will get funded. You don't have to worry about, oh, are the banks going to come back? Is the PE going to come back? Is the retail investor going to come back? Is their private placements going to get enough interest? At $100 oil environment for 12 months, 18 months, every single thing out there will get funded in terms of enhanced oil recovery or conventional development. That's just how the market goes. That's not to say every company will decide to fund everything. They may choose to say, no, we're not going to develop these properties. No. But whatever is looking to get funded with barrels of oil in the ground will get funded. So if that's the oil price environment that you're betting on anyways, I wouldn't worry about the day-to-day, oh, how are they going to fund the CO2? How are they going to drill wells? Because they're not doing it right now. They just don't have the money. They will do it when the pricing environment gets there. If you think the pricing environment is not going to get there, then you shouldn't be an investor in that company to begin with. So I find this sort of logic helps calm a lot of the nerves and the anxiety around what is or is not happening here in the sector. So yeah, that's how I see it. I think the whole break even question, it's a good question, but to me, what you understand out of it, I don't think is what people think. They think if they know the break even of a company, they all of a sudden feel safer, or they feel like that company is going to do better for some reason. That's not true, in my opinion. So there's many ways that the break even can change. There's many ways that the break even of a company can be call it mitigated by just not putting money into decline rate mitigation. If you just cut capex entirely, a lot of these companies can survive $45 oil for 6, 12, 18 months. But you have to be willing to live with the decline rates on that asset itself. And let's say a company has a break even of $60 a barrel, but yet they're carrying 2 times or 5 times their equity in debt, versus the company's break even is $80 a barrel, but yet it's a complete net cash company with 2 times their market cap of cash on the books. Just throwing exaggerated examples out there to show you that simply looking at break even, although it tells you something, to me, it's just not something I would focus my attention on at all. I would look at the free cash flow yield at a certain price. I would look at the cash flow yield at a certain WTI price, and kind of go from there. So there's a question here. So in defense of focus on break even, doesn't it help protect the company from selling assets off in a fire sale of an 18-month downturn? again, I'm going to be completely blunt about this. If you think we have an 18-month downturn upcoming, don't invest in high break-even oil companies. That's it. You cannot have your cake and eat it and eat it too, because let's say you have an 18-month downturn, and your company's break-even is $60 a barrel. What's to say that the shares don't fall 60% or 80% or 90%? Just because the company doesn't go under or doesn't sell any assets doesn't mean your equity isn't completely wiped out for all intents and purposes of a discussion, right? So many factors. I think it requires a more nuanced discussion, but I see a lot of new investors and even experienced investors focus too much on the break-even price to determine what they invest in. There's definitely uses for it, but I feel like to understand break-even, you have to put in a lot of work to understand the other parts of the company, and that's really the unfortunate part of using a metric like break-even. It has its uses, but other metrics are just easier to understand and give you a better, more complete understanding of the company to make your decisions. Just my view. Other people may come back and say, look, the break-even tells me exactly what I need to know. Fair enough, completely fair enough. I see nothing wrong with it. I just think I get way too many questions about break-even oil price on my email and on my Twitter, as if that's going to protect the company in some sense. So just keep that in mind. The break-even doesn't restrict the company from losing its equity value over a period of time. I can name various companies that I've discussed today where the break-even would have been $45, $50 a barrel, and the company still got bought out at 1/10 of its reserve value, or the share price is still dragged down to X valuation. But yeah, appreciate the question either way. And I think the comment is correct. Yes, the break even is $70 per barrel with the reactivations. Yes. Yeah. Okay. So with that, I will wrap it up. Always a pleasure. So I think I'm going to take a break here next week. I got a buddy coming down to San Diego, so I'm going to take a break, and then we'll keep the schedule as updated as possible. And I will plan to do the part 2 of this presentation with the other 15 companies, possibly in September or October time. And yeah, we'll just keep it going. I think the next one I have coming up is a bunch of petroleum engineering topics. I'll have to check my schedule, but might update some of the topics here in the next couple of days, and go from there. So hope everybody has a great rest of your Sunday, and we will catch you at the next one.